have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%.
We're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
Inflation has already risen significantly higher than the Fed had earlier predicted it would.
A lot of consumers are very forgiving now because they're finally being offered parole from cabin fever.
Inflation is likely to run ahead of expectations, but I think it'll settle out at around 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Let's get the week started from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Tom Keene, I'm Jonathan Ferro, back together again with a wonderful Lisa, back in her chair. She's back from her vacation, and I believe she has no vacation days left. We'll talk about that later. Equity futures coming in just a little bit this morning, Tom. What a week we've got lined up.
It's the way they're coming in, John. This is an important market moment. You have real yields breaking down. I'm sorry, John, if you can get to the real yields, see it, folks, Friday afternoon with where we are now in inflation-adjusted yields. It speaks volumes. Who do I want to talk to this morning? I would kill, John, to talk to Lawrence Summers about stagflation.
Well, we've got to talk about this equity market with Lori Calvasina shortly,
yes.
Tom. The earnings, a huge amount of tech earnings through this week. Then it's on to Chairman Powell this Wednesday, Tom.
Jim Suva publishes on Apple. He says, there's going to be some noise, Taiwanese floods, a Delta variant playing into it, all the dynamics in China, but it's going to be a bang up earnings week.
You mentioned China, Tom. Let's go there. Lisa, welcome back. You've got to hit the ground running this time. The Hang Seng and a CSI 300 over in China, Hong Kong, getting absolutely battered.
And this is the build on from what we saw at the end of last week when China came out with the crackdown on education companies in particular, saying that they possibly may make them all be not-for-profit, or they're going to crack down on the profitability of these companies. I find this interesting because regulatory uncertainty is taking on a new meaning in China. And a lot of people are saying these stocks are virtually uninvestable. And there's a broader question of how far China will go in this crackdown and why. John, they're doing it.
CSI 300 down 3%, Hang Seng off by more than 4%, and some of the names listed over here, Tom, are getting crushed. DD, I think the poster child for some of that price action over the last month.
But John, is it part of the overall market, or is it a truly idiosyncratic story? I'm reading it right now, idiosyncratic.
Well, I think that's the issue at play for a lot of people. What's the transmission mechanism for this sell-off to bleed into the rest of the world, into global markets? A lot of people talking about maybe the middle of 2015. Who remembers that? When the equity market bubble in China popped. I think this is very, very different, Lisa. And a clear message, when you think out something like education, it's hardly surprising that an autocratic regime like the Communist Party in China wants to clamp down on the privatization of education. Point one. Point two, I'm surprised that they allowed the proliferation of that particular industry in the first place.
There's a larger question, though, that you asked earlier, which is at what point is there a transmission mechanism? Is this idiosyncratic, or is this something that could spread to the broader market? I'm very curious to hear from Lori Calvasina about the momentum of earnings per share revisions, upwards, downwards. The momentum is actually declining. This is what I was thinking about as I was communing with my people, the loons and the bears up in the Adirondacks.
That's your constituency.
Yes, correct.
Lisa returning to her constituency over the last week. Welcome back.
Thank you.
Lisa, good to have you with us. Let's get to the price action this Monday morning. Good morning to you all. If you're just tuning in, equities down about 9 off the lows of the session, negative 0.2% on the S&P into Monday. 4-day winning streak on the S&P 500 and a really tidy, nice big week of gains on the S&P, the Nasdaq and the Russell as well. We'll talk about that in a moment. Yields lower on a nominal yield by 3 basis points, Lisa, 124.62. It is the real yield that gets your attention, I'm sure.
Yeah, definitely. Negative real yields, the most negative they have ever been when you look at the 10-year real yield in the United States, raising questions about how patient the Fed will be, what kind of communication. Will they come out more dovish on Wednesday when Fed Chair Jay Powell gives a press conference? It is such a busy week. Today, a little bit less so. 10 a.m. we're going to get new home sales. The expectation is actually for a gain after a surprise decline at last reading after, of course, prices rose to the highest levels ever. There is a question of this supply-demand dynamic, the idea of just is there enough supply to meet demand? This is the persistent story almost in every industry post-COVID. And then 1 p.m. kicking off a big week of Treasury auctions. And I'm interested in this. About $60 billion of 2-year Treasury notes being sold. The idea here is how much pushback is there on the idea that the Fed will remain on hold, will remain patient, even as we see these inflationary pressures persist? A lot of questions around what does transitory mean and how much will the Fed potentially redefine this as it sees it fit? And then, of course, after market, Tesla, among the big names that are going to be reporting earnings this week. John, you were talking about big tech. And of course, we're going to expect to see some sort of indication in China demand, supply chain issues, batteries. And I'm interested in also how much their carbon credits continue to support their profitability, as well as potentially selling some of the software behind the autonomous driving, John.
Lisa, thank you. Tesla, after the close, reporting earnings a little bit later this afternoon. Then it's on to Apple, Microsoft tomorrow, Facebook Wednesday, and then Amazon this coming Thursday. Let's get to Laurie Calvasino, RBC Capital Markets Head of U.S. Equity Strategy. And Laurie, let's start right there. What are we learning so far from the incoming earnings?
So, look, I think this is going to be the pivotal week, right? It's crazy busy. We've got well over a third of the S&P and some of these, including some of these big tech behemoths. I think what we're learning so far is that the value side of the market, the financials in particular, look like they're the weak link at this point in time. So far, we've actually seen some resilience in areas like technology and growth revisions generally, while we've really just continued to see continued slippage on the financial side. So I really want to see this week if we're going to get confirmation of that trend, if we're going to maintain that tech resiliency. Look, I think in terms of other things that we are learning, one of the fascinating stats over the past week that I saw was that 2021 bottom-up S&P EPS moved up a couple bucks, but 2022 stayed flat. And so the growth rate for next year came down a little bit. I want to see if we're really going to continue to see that enthusiasm build on next year. If not, I think we interpret it as sort of a continued slippage in earnings sentiment. And we're seeing other things that suggest that that's happening as well, despite some of these really strong beats that we're getting.
Do you think downgrade risk is starting to build here, Laurie, looking ahead to next year?
I think so. I mean, I think the issue, right, it's a question of the rate of change versus the dollar level. And that rate of change we have very clearly seen for 2022 starting to slip just a tiny bit. Now, the tech companies could cause that to reverse. But what we've basically got now is peak upward revision. So if you looked back in June, the rate of upward revisions in the S&P 500 was 78%. And so far in July, that has slipped to 74%. So what you have first is a deceleration of upward revisions. You just get fewer and fewer of them. And then it eventually translates into downward revisions. And those downward revisions may take a little bit of time to come. But it does look to me that we're already in that decelerating upward revision pace, and about half the sectors are contributing to that right now.
Laurie, a two-part question with a one-part answer, and it's the idea that can stocks rise amid slow growth, rates come in, real yields come crashing down, and yet we're supposed to believe that equities rise. And I combine that with a wonderful Jeffrey DeGraff over at Renaissance, who says, look, you can't have momentum unless you have breadth. Which is it right now? Momentum, or we need rebuilding breadth?
So, look, I would say the composition of the market is very, very different than it's been in the past, and it depends on what causes that choppiness. Right now, we've got a market that's concerned about slower growth, not an outright recession. And so that's feeding these secular growth trades. It's feeding the tech trade. And the overwhelming market cap bias right now is towards that growth and tech sector. The TIMT space outweighs the cyclicals, and that's not normally the case in the S&P 500. If you were to see an outright growth scare where really something more nefarious has begun to be anticipated and the market wants to flip out of secular growth and into defensive, that will drag the market down. But while we're in sort of this purgatory of slowing growth that's not that bad, you could actually see the market continue to creep up just because of the composition of the market cap right now.
So let's talk about the composition and the idea that growth, you're seeing more earnings revisions upwards, that they are stronger in the growth stocks than you're seeing even in value, despite the fact that you're seeing this potential rotation. What does this mean to you?
So, one thing I've noticed on the value side, and we make the case that sort of the cyclicals are dragging down the revision ratios. It's actually only part of the cyclicals. It's the financials. The energy companies have still been decently strong. The materials companies have still been decently strong. For us to really say there's a massive problem on that cyclical trade, we'd probably need to see the energy and materials sectors start to falter a bit, and the industrials as well. We're not seeing that yet, but it's clearly something we've got to keep an eye on.
Laurie, great to catch up with you. on a massive week ahead. Good to see you again. Laurie Cavacina, RBC Capital Markets, head of US equity strategy. Laurie mentioning the composition of this market, heavily weighted towards big tech. So let's go through the week. Apple, more than 6% of the S&P 500, report tomorrow. Microsoft, almost 6% of the S&P 500, report tomorrow. Amazon, Thursday, more than 4% of the S&P 500. Facebook, coming a little bit later in the week, Wednesday, a little bit more than 2% of the S&P. And then Alphabet, 4% of the S&P, Lisa. They come after the market tomorrow. That's a massive lineup, a huge chunk of change on this S&P 500.
And the expectations are high. However, cash flow has been incredible as well. I'm curious not only about the top line growth, the bottom line growth, but also what they say about how much wages are going up, how much their labor shortages they expect to persist, because what we're seeing is the expectation among businesses that some of these issues that people have called transitory aren't so transitory, John.
This divide between the language of the economists, Tom, the language of the central bankers and the language of the C-suite couldn't be starker over the last couple of weeks. I caught up with Mohamed El-Erian just to close out the week last week, and he mentioned that's the huge distinction that underpins why his view is so different from the Federal Reserve's. And this was the quote: "I have a whole list of companies that have accounted for price increases, that have told us they expect further price increases, and they expect them to stick." And you've heard that repeatedly, Tom, in earnings calls over the last couple of weeks.
I would not conflate those conversations. To me, it is the C-class officers and, frankly, mid-sized, non-publicly traded businesses adapting to what they see. You know, we haven't even talked about the new touches of the pandemic and Delta variant, but I would suggest markets and corporations are adapting to the efforts of those institutions.
And there's price tolerance there, Tom. And Lisa, that's the encouraging part of all of this for corporate America, I guess.
That is, however, you have to wonder how much is being passed on to the individuals who are purchasing things. Even President Biden acknowledging this at that point.
Slowly, a change of language at the White House. Really nice piece from the team down in D.C. on that we'll get to a little bit later. We'll head down to Washington in about 5-10 minutes on this program. On your S&P 500, we're down 8. We're negative almost 0.2%, and a wonderful lineup for you to kick off the trading week. In the 8 o'clock hour, Paul Romer, the NYU professor and Nobel laureate. Looking forward to that at around about 8:30 Eastern. From New York City this morning, good morning. This is Bloomberg.
With the First Word News, I'm Laura Wright. China is lashing out at U.S. policies in a tense start to high-level talks. Chinese diplomats handed their American counterparts lists of demands and declared the relationship between the two was still at a standstill. China's Vice Foreign Minister says the U.S. is trying to contain China. House Speaker Nancy Pelosi has issued a warning she won't back off her plan to hold up a bipartisan infrastructure bill until the Senate delivers a larger Democratic-only spending plan. Republican senators warn that Pelosi's strategy could threaten the deal. A growing number of public health experts in the U.S. are urging the CDC to revise its guidance on masks. They say the agency should recommend that even fully vaccinated people should wear masks in public. That's because of the resurgence of COVID cases caused by the Delta variant. In the UK, the number of new coronavirus cases has dropped for the 5th day in a row. That's a potential boost for Prime Minister Boris Johnson following a chaotic week since the lifting of pandemic restrictions. Johnson's government has sought to encourage a return to normal life over the summer. It's dropped social distancing rules and done away with mandatory mask wearing. Bitcoin soared today and is now approaching $40,000. Some are attributing the rally to traders exiting bets on declines. There's also speculation about Amazon's potential involvement in the cryptocurrency sector. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
The bill is not as green as I would like it to be, the infrastructure bill, and I think that it's something we could have passed a long time ago, even before the climate crisis was readily known to everyone. But nonetheless, I hope that it will pass.
We're told this might be the week It might be the week. That was House Speaker Nancy Pelosi on ABC this week. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Back together again. Lisa's back in the seat. Good to see you, Lisa. Your equity market down 8 on the S&P 500, negative 0.2%, well off session lows, a bounce back in the last couple of hours.
Yeah.
In the early part of this session, we had a little bit of a nosedive a few hours ago. Tom, outside of that in the bond market, yields lower by 2 or 3 basis points, 124.79. Euro just a little bit stronger, trying to reclaim a 118 handle at 117.94. Tom, that currency pair advancing 0.2%.
Yeah, I mean, it's a little bit of a pickup here in the last 90 minutes. I look at the 10-year yield of 4 digits, 1.2479. But, John, the set on this Monday into a huge news week is decidedly towards lower yields.
People are still asking the same question, Tom, whether it's 125 or 112.60 last week. What are we doing down here? And that's what I imagine the conversation might look like on the FOMC as they get together tomorrow and conclude that meeting on Wednesday.
Yeah, and looking at European yields, Swiss 20-year, which is my benchmark, comes in lower and not through to record lows, but nevertheless, the settling here of lower yields this morning talks about growth. On the growth of infrastructure debate in Washington, Emily Wilkins joins us now, Bloomberg government reporter. Emily, our team was channeling Greg Valliere this morning. He minces no words. Speaker Pelosi is the most important person in Washington this week. Why is that?
Because she is the one who's going to be needing to hold the House members together. And what happens in the House is incredibly critical to what happens in the Senate. You are seeing a number of House lawmakers come out at this point and try and make demands about what they want to see in that bipartisan infrastructure bill, threatening to vote against it. I mean, I know that we're talking really tight margins in the Senate with those 50 senators all needing to be on board, but the House has equally tight margins. They can only afford to lose about 3 to 4 Democrats on any vote before things aren't going to be able to happen. And as you saw over the weekend, Pelosi is continuing to stake out a strong stance, saying that she's not going to move that bipartisan infrastructure bill until the larger $3.5 trillion reconciliation package is ready to go, and sort of setting the tone for how this will be moving through Congress and to the White House.
So the liberals say, Speaker Pelosi, go get him. When does she, or how does she, or what's the process where she blinks? Is it a phone call from Senator Biden?
I mean, it might wind up being that. Should the White House decide that, look, this is a strategy we need, we're going to need to make sure that the infrastructure bill moves first. But right now, the calculation for Pelosi, as well as the calculation for other Democratic leaders in the White House and in the Senate, is that they are going to be able to move that infrastructure bill through the Senate, get it to the House, and then move that reconciliation bill very quickly through as well, so that the two of them can be voted on in the House together. Big concern for Democrats, progressive Democrats, is that the infrastructure bill gets done and then suddenly there are no more votes or no more momentum for that larger reconciliation package.
Emily, last week when I was communing with the Loons and the Bears in upstate New York, I was trying to make sense of the question that John and Tom were talking about of why Treasury yields fell to 1.12% or something crazy last week, the lowest ever, given the fact that we're looking at, basically a GDP that we're going to talk about potentially 13% annualized this year. A lot of people pointed to lower expectations for anything getting through. And if anything gets through for infrastructure, it'll be on the smaller side. Do you feel like there has been a shift in Washington, D.C. as well? This idea that perhaps people are lowering their expectations, lowering their hopes, and that something won't necessarily be big and bold, period, full stop?
There are definitely people in D.C. right now, very smart people, who think that we're going to wind up seeing a smaller bill, or that we'll only see infrastructure pass without this larger reconciliation package, or this $3.5 trillion reconciliation package is going to be going much, much smaller. But at this point, a lot of it's going to be coming down to this week. Are we going to see this bipartisan group of senators come out with an agreement? I mean, Rob Portman, one of the lead Republicans with that bipartisan group, said they're 90% of the way there over the weekend. 90% is not 100%. They've been saying that they're so close for so long now. And it's going to hit the point soon where Democrats are just going to turn to President Biden, turn to Senate Majority Leader Chuck Schumer and say, hey, if Republicans don't want to go with us, screw it. Put the infrastructure stuff in that larger reconciliation package and let's get something done. Yeah. The concern, again, is that they don't want to be held up by the Republicans too long.
The broader question is also the conversation around inflation and how much that's shifting. We're seeing President Biden change his tone, acknowledging that people are spending more when they go out and buy basic goods and services. How much is this weighing on the debate?
right now in Washington, when I talk to lawmakers, if you talk to Republicans, they will talk about inflation as a way of criticizing that larger package Democrats are trying to move. But if you talk to Democrats about it, they're not thinking as much about inflation as they are thinking about 2022 and the upcoming midterm elections. There is a big sense that they do have to get something done if they want to win with voters in the midterms. And that's what's really driving them here. I mean, certainly they're keeping an eye on inflation, but at this point, it hasn't limited any of the Democrats' ambitions for what they want to do with this bill.
Emily Wilkins down in Washington. Emily, it's good to see you. Bloomberg Government's Emily Wilkins down in Washington. Your update on the infrastructure push. Lisa bringing up the inflation component of this debate at the moment, Tom. Nancy Cook of Bloomberg wrote a wonderful piece over the weekend about this, about how the administration was going to drop the word transitory. It's become such a loaded word now with a ton of baggage. And I think the Republicans, to some degree, have been successful, Tom, about shaping this debate, shaping this argument to push people further away from these massive numbers down in Washington.
Well, yeah, that trend is clearly there. There's no question about it. I believe we have a working number on the first bill of under $600 gajillion a year. John, the overlay to me of all of this, the FOMC meeting, frankly, even earnings calls that we'll get on technology this week, and certainly what we see in Washington is the pandemic and the virus. I'm sorry, this weekend was a change along the path of, 18 months?
Well, let's get to Wednesday. Let's get to the news conference. Does the language change? Lisa, does the language change in line with what maybe the administration is thinking about, that this word transitory is now meaningless to so many people, including the likes of Jason Furman?
Well, yeah, and that's, to me, the idea that Jason Furman was quoted in a Bloomberg News story saying, I have no idea what the word transitory means. Inflation is currently running at a 9% annual rate. If it goes to 7%, does that mean it was transitory because some of the 9 went away? Does it need to be 2 to be transitory? And I think this is the key question. Is it enough to just say, look, things go up, things go down? And that's essentially what transitory means, John.
The Federal Reserve hasn't helped with this at all, have they, Tom? And I just wonder if they do need to change approach here. The T word isn't doing much for anyone anymore. It's not helpful.
No, it's moved on. It's like V-shape. It's, the
what does it mean?
Is gone.
I agree.
No, it's just gone. We're in search of maybe a new phrase to use here. The phrase for me is, how do you as a Fed show any kind of hawkish tone or reversal of dovish tone given the health news that we're seeing? To me, it's unimaginable he can push against that.
Looking forward to catching up with Johns Hopkins a little bit later this hour to get into some of that detail. Tom, your equity market down 9, negative 0.2% on the S&P 500. Your bond market yield south of 125 at 124.95. We had a look at 112.60, the lows of last week. Tuesday morning, a lot of people still scratching their head about the bond market price action. We'll scratch our heads for you through the next couple of hours and ask the right questions, I hope. Euro dollar, 117.94 from New York. The band is back together, I'm pleased to say. From New York, this is Bloomberg. Live from New York City for our audience worldwide, a good Monday morning to you. Here is the Monday morning price action. Your equity market off the lows of the session, still slightly negative. We're down 9 on the S&P, negative 0.2%. Bit of relative outperformance on the Nasdaq 100, down just 0.1% there. The top 7 on the Nasdaq 100 reporting over the next 3 days, Tuesday, Wednesday, Thursday. We'll get into that in just a moment. Big debate, though, for the broader market. Top down, cross asset, the relationship between this equity market and this bond market. Switch up the board and get to your nominal yields, 2s, 10s and 30s. They look like this. Your 10-year right now, 124.95. Yields in a couple of basis points. Yields lower on the day, the curve flatter on the session. Over the last couple of weeks, though, we've been all over the place. The round trip from 112.60 at the lows last week all the way back through 130, and now somewhere in between on 10s. But the big headline of the morning, and Lisa loved this one, I'm sure, when she returned back to work. Switch up the board. This chart right here. Real yields, 10-year real yields, a record low negative 1.12%. And the last time we were in and around these levels and we had the Nasdaq outperforming was the back end of August. And I don't know if this moment has echoes of that. The difference for me, what I think is happening here, and we've talked about repeatedly, Tom, is how we've unwound the positive growth shock of Q1 in this bond market completely, entirely through the year so far. And if you look at this move from January through to where we are now, that's been the story for me. A series of aggressive upward revisions to growth through Q1, real yields adjust, and then we completely unwind the whole thing over the last couple of months, Tom.
John, thanks so much. We have a set of headlines out in the last hour from Asia, and it is an Asia in turmoil, obviously because of the pandemic, but much, much more than that, including China action. U.S. officials are meeting with Chinese officials. I'm going to call it, it's not Biden-Xi, but it's important senior meetings, and the headlines are simple. The United States urges China to halt economic pressure of allies. Next steps in the talks also up to Beijing. And that is a continuum of Asia. That is something that Juliet Sally specializes in Singapore, and we're thrilled to drag her in on her Monday evening. Juliet, in the 1,500 miles from Duterte's Philippines to your Singapore is the span of Asia. Duterte has monsoons, flooding in Manila, 13 million people, and a pandemic going the wrong way. Singapore is a trophy child of successful pandemics, but both of you have to deal with China. What does the region look like right now, since everyone has to deal with China?
Yeah, absolutely, Tom. It is the key sticking point. And I think what was really interesting about these talks that we had from these officials today was that they were hopefully going to set up talks between Presidents Xi and Biden at the G20 in October. That's at least the hope. But it certainly is the key theme for here in Asia and for investors in Asia too, and also just in terms of opening up this economy too, because remember, China pretty much has its borders shut due to the pandemic, as does Hong Kong, as do we here in Singapore, and most of the Asian nations. So it is a matter of trade. We heard those digital free trade agreements announced a couple of weeks ago, and also just in terms of how this region is going to move with what everyone is calling the new normal once you see vaccination rates pick up. But they are very different across the region as well, Tom.
Juliet, is the idea here for these U.S.-China talks to set the stage for that potential October meeting between Presidents Xi and Biden, or is there something more substantial that could come of this, a tangible kind of result, in addition to the headlines that we expect that talks have shown that a deteriorating relationship with the U.S. and China is ongoing?
Well, yeah, and that's been the key theme really since about 2018, hasn't it, Lisa, particularly at the height of the Trump administration, as we started to see those relations between Washington and Beijing unravel and then move into the new administration, the new Biden administration, trying to, I guess, change things here too. But as you alluded to earlier with these headlines coming through, it does seem that at this point the ball seems to be in Beijing's court. I do want to talk more broadly, though, about this clampdown that we have seen from Beijing once again, creating a lot of regulatory headwinds, particularly for foreign investment. And that's what we saw across equity markets today with this big clampdown coming through on the education sector. We had heard rumours of this on Friday, which flowed through into Wall Street session. Then we had the confirmation on Saturday that there is going to be a clampdown on this online education sector, a broader clampdown of the tech sector, which has seen the Hang Seng Tech Index wipe some $550 billion from its peak. Big selling, as you can see, coming through in a number of these key indexes today. The Hang Seng China Enterprises Index now in bear market territory, and the Hang Seng Tech Index back at July 2020 lows. And the big question is here, how is President Xi managing the economy? What sector could be next?
Juliet Sally out of Singapore. Good to catch up, Juliet. Thank you. Your equity market on the Hong Kong Hang Seng down by more than 4%. The CSI 300 down by more than 3%. Earlier on this afternoon over in Asia, Tom. This spat between China and the United States, we just had the account there from the U.S. side of things. It's always good to get a full account of how things have played out. The U.S. urging China to halt economic pressure of allies. This after the Deputy Secretary of State, Wendy Sherman, met with Chinese officials. Here's the Chinese account of how things played out, Tom. This came from CCTV. They want the United States to unconditionally revoke visa bans on China Communist Party members and their relatives, revoke sanctions on Chinese leaders, officials, government departments, revoke visa restrictions for Chinese students. This goes on and on and on. Stop harassing Chinese students, stop oppressing Confucius institutes, revoke requirements to register Chinese media as foreign agents or foreign missions. Tom, there is so much to get through here, and that really is my point.
Yeah,
a lot of this is not going to be solved for a long time.
And some of this, John, was the United Kingdom over the weekend. I thought the British papers had a lot on the unique relationship, the fractious relationship with the United Kingdom and China. John, to me, what's important here, we're looking at the real yield, we're looking at currencies, yes, the equity market. But the bottom line here is you have to fold all of this tension of the Pacific Rim into it.
Without a doubt.
No,
that's the politics. But then you've got the markets. Look, I still don't think we've got anywhere near the bottom of what happened with Didi. Didi Global, Tom, to come here to the United States, and I'm surprised we haven't heard more from the administration on this, to tap U.S. capital markets, for the amount of money they tap U.S. capital markets for, and then for the Chinese regulator to turn around and reportedly had pre-warned them before they went public. There is a lot to work out here and unpack.
There is. Right now, to continue this discussion as we go bigger, broader in this segment, Jed Dorsheimer joins us with Canaccord Genuity. Yes, he's a senior equity analyst, but far more than that, he's actually really committed to a study of sustainability. That's really been his hallmark at Canaccord Genuity. On Tesla, Jed, in the linkage of Tesla as a global company, are they getting it done?
They have so far. I mean, Tesla should be credited with what they've been able to do in terms of leading the pack. Now, I think, as we look at this quarter, there's a couple challenges that Tesla has in front of it. We've already got the delivery numbers out, but as you look at the S and X, really it's the 3 and Y that are carrying things for them. So we need to figure out what's going on with S and X and their ability to ramp. But maybe just taking a step back, as you kind of talk about the broader picture, competition in EVs is certainly heating up. And that has been from Tesla leading that path. Our call on Tesla has been more about the energy and their ability to scale that, which they have failed thus far to do. So that is something that we're kind of keeping our eye on there. And that does relate to a lot of sustainability and their ability to kind of lead that.
Jed, I remember when Tesla could do no wrong and the shares continued to rise no matter what. They are down nearly 9% on the year, dramatically underperforming the broader market. What will it take? What are you looking for in today's earnings to see whether you could potentially have a turnaround and a rally into year end?
Well, I think if you look at Tesla's getting the premium of being the leader in the market. So as you see others encroach, that's going to be a risk on that multiple, where you could see multiple compression. That's going to be the bigger risk in terms of what the stock does. So really, this kind of goes to our call. Can they actually get the 4680 battery and signs of that, which will allow them to scale into the energy storage market, which opens up another big TAM for them to kind of lead the way. And if they can't do that, then and they're relegated to just autos, where there's more competition coming in, that's probably going to weigh on the name and lead to a downward trend versus our more bullish call in terms of seeing things turn around for them.
Just a final one from me, just to really pin you down on this one. How would you characterize this relationship between Tesla and China right now? And what's the degree of risk around it, given what we're seeing play out every single morning at the moment, more broadly?
I think it's a growing and bigger risk here for the name. I mean, I think Tesla could be, what you're talking about in terms of U.S. relationship is certainly a harbinger for other companies that have, 1 foot in each geography. So for Tesla, I think that is going to be a tricky situation. You've seen government impact in terms of sort of what batteries they're using over there, as well as what they can do with their autonomy and data. So I think that's going to continue to be an ongoing challenge for Tesla.
Hey, Jed, good to catch up. Good to hear from you. Jed Dorsheimer there, Canaccord Genuity Senior Equity Analyst. Tesla reporting after the close a little bit later. We've got to hit a much bigger conversation now for this pandemic. Mr. Fauci, Dr. Fauci, Tom, alluding to the fact there is an active conversation now about reintroducing revised mask guidance again. We're just not taking the right steps in the right direction at the moment in this country.
Any number of ways to look at this, and I think the coverage, John, over the weekend actually was really quite adult. I think there was a fair amount of statistics and anecdote, and also the immense political pressures good politicians are facing. And John, do you think I'm right? It's every city for themselves?
Well, Dr. Fauci alluded to that, Tom, that maybe the local decision makers get to make the decisions that need to happen here, and perhaps it doesn't come from the federal level. That's the conversation we need to have with Johns Hopkins, Bloomberg School of Public Health, Vice Dean, joining us very shortly. Your equity market down 10. We're negative 0.2%. Your bond market is bid. Yields are lower by 3 basis points on 10s to 124.45. This is Bloomberg.
With the First Word News, I'm Laura Wright. The White House is shifting the way it talks about inflation. Polls show there's increasing voter concern about rising prices, and Republicans are trying to use the issue to kill President Biden's plans to spend trillions on social programs amid infrastructure projects. Democrats plan to have the president use plain language explanations and assure people the price hikes will fade in time. Don't expect those labour shortages in the US to go away anytime soon. According to a survey of business economists, only 6% expect the shortage of workers to ease off by the end of the year. Nearly a third of those responding to the survey say they don't know when the problem will be resolved. The survey was conducted by the National Associations for Business Economists. China has announced a broad set of reforms for private education companies. It wants to decrease workloads for students and overhaul a sector it says has been hijacked by capital. Education companies will be banned from making profits, raising capital, or going public. That sent shares of edtech companies plummeting. In the US, NBC saw a huge decline in viewership for the opening ceremonies of the Olympics. Friday's event drew in around 17 million viewers, including people who streamed the event on NBC's digital platforms. That's down about 36% from the opening ceremony in Rio 5 years ago. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I'm not so sure it would be the worst case scenario, but it's not going to be good. We're going in the wrong direction. If you look at the inflection of the curve of new cases, and as you said in the run-in to this interview, that it is among the unvaccinated. And since we have 50% of the country is not fully vaccinated, that's a problem.
Things are moving really quickly. That was Dr. Anthony Fauci there speaking on CNN's State of the Union from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action this Monday morning. Equities off session lows after China shakes things up just for a moment. We're negative 10. We're down 0.2% on the S&P. Outside of that, the bid sticks in the bond market. Yields heading south, lower. Treasuries firmer. Yields down 3 basis points to 124.45. Yeah. Euro just a touch stronger here. Euro dollar approaching 118 again, Tom. 117.97. We're positive there, 0.2%.
We're watching this, folks, to 4 decimal points, which is called pips, like Gladys Knight and the pips. And John, I'm sorry, the ebb and flow here, given the news flow this week, is important. A little bit of a worserness to it. And this
COVID infection story, Tom, is getting a ton of attention. I would say some good news out of the UK. Cases are starting to trend lower again over the last 7 days, over the last week. That's really, really important. Deaths ticked higher. They're still very subdued relative to where cases have gone, relative to where we were, say, maybe 12 months ago. But these high-profile athletes keep getting caught out. We've talked about the Olympics earlier this morning in our First Word news takes. John Rahm, the Spanish golfer, tested positive for COVID during a tournament in early June, Tom. And now he's tested positive again and has to withdraw again from his second tournament in just the last couple of months. And this tournament, of course, is the Olympics. So we have these high-profile breakthroughs of individuals that have been vaccinated, and that seems to be getting a lot of people's attention as well, Tom.
It does. Let us move forward now, and we are honored to bring you, as we have for too many months, Joshua Scharfstein. He's with Johns Hopkins Bloomberg School of Public Health. Of course, Michael Bloomberg, benefactor of this television and radio program in his business of running Johns Hopkins. That's a joke, folks. Dr. Scharfstein, thank you so much for joining us. John and Lisa have a wide set of questions. We could talk to you for an hour. What's the when and where of masks for you in August of 2021? What are we going to in this next round of wearing or not wearing a mask?
Well, I would say it's probably not a uniform recommendation, given that vaccination varies so much around the country. Where there's very high vaccination rates, the rates of the virus are very low. Where there's low vaccination rates and the virus is very common, it will probably make sense for people to put masks on indoors. And that's why you're seeing some local health officials recommending that. It's just to protect people until we can beat the virus back again.
What is the efficacy of a federal approach, let's say CDC, versus every city, every town, every zip code for themselves?
Well, there's obviously a middle ground here, which is where CDC gives guidelines. This is when you should seriously consider putting in place an indoor mask requirement. So it then applies to each place based on the condition of the pandemic in that area. I think that would be a good idea.
All right. Meanwhile, we're seeing protests happening around the world for some of these restrictions, saying enough is enough. If you want to get vaccinated, go get vaccinated. If you don't, why should we live our lives in fear? We are accepting our risk. We should just move on. How much, as public health officials, do you respond to these protests and you realize that we are entering a new phase where people do, at least in places like the United States and the United Kingdom, have a choice of whether to get vaccinated or not?
Well, here's the problem. People say, this is our freedom. I definitely don't want to do it. It's often based on just frank misinformation. They don't understand what's actually going on. And then they get sick. And when they're sick, they don't say, actually, I chose this. I'm perfectly happy to be sick. They go, what was I thinking? And I really wish I could be vaccinated. And can I get vaccinated now? That's what, a physician in Alabama reported. And, that's heartbreaking. And so as a public health official, you see both sides. You see people, adamant that they're choosing, the ability to let life go as it may. And then you see people on the other side and their families and all the people who didn't make that choice get sick. And you realize that there's a bigger picture here of community health.
There is also a question about the vaccines and the specific inoculations and their efficacy rates with respect to the Delta variant. Which is the best vaccine when it comes to protection against infection from the Delta variant?
Well, it looks like the mRNA vaccines, the Moderna and Pfizer vaccines, have very high protection against the Delta variant as long as you get 2 doses. So it's not just the first dose, very weak after the first dose. From what I can tell, and, I would say we need more data. Johnson & Johnson is a little bit more of a question mark, but there's some clinical evidence of protection there too. So, I think being vaccinated is much better than being unvaccinated. And 2 doses of the mRNA vaccines looks to be quite protective.
Joshua, we've got to run. We've got to leave it there. Thank you, sir. Joshua Scharfstein there of Johns Hopkins, Bloomberg School of Public Health. We've talked through this morning about the risk of downgrades. That's why we started the conversation with Laurie Cavasina of RBC about an hour ago. This is Jan Hatzius and the team over at Goldman Sachs. It is a downgrade to the outlook. Quote, in the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. They go on to say at the bottom of the first page, we have therefore lowered our 2021 second half consumption growth forecast, resulting in 1 percentage point downgrades to our GDP growth forecast for Q3 and Q4. And at the very bottom there, the line that I'm sure jumped out to you, Tom, on the outlook for trend-like growth in America, 1.5% to 2%. By the second half of 2022. So this is a sharper deceleration that the team at Goldman are looking for, Tom.
John, when Jan Hatzius visited us this 8 weeks ago, he alluded to this, but they're putting more cast in stone, chiseled in marble right now, this call. The second half 2022 sub 2% number is stunning. And John, there's one great chart. I know you've got the note, John, Exhibit 3, which is, and I want to put it in the Goldman Sachs language, office attendance remains at just 1/3 of the pre-pandemic level in major cities. So this is it's a very complex note leading to a reduced GDP outcome.
If I was to make it really, really simple, this is about delaying the full service sector recovery. That's the issue at play here, and leading to a sharper deceleration from the peak rates of growth we're experiencing right now and what we're about to see play out in the coming quarters, Tom.
How do you fund this debt and deficit with a potential growth under 2%?
I think what you'll find, Tom, if we see more people follow the likes of Jan Hatzius at Goldman, yields are going to stay exactly where they're at. It's hard to make the argument, Lisa, if these forecasts start to build up and move in the wrong direction, that yields spike higher from here.
One of the key factors in terms of return to office and in terms of the recovery, and not to be self-serving, but is the return to schools. And can individuals who go to school, who go to elementary school, junior high school, continue to go in person? Are you going to see disruptions? Are you going to get mandated vaccinations? Are people going to be in masks? We still don't know, and we're just weeks away from the start of the year.
The risks at the end of Q3 and through Q4. We're going to build on this through the program from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Your equity market, we're down 11 on the S&P. We're negative 0.25%. From New York City, this is Bloomberg.
You have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%.
We're in a regime shift. We're going to now see growth decelerate and inflation decelerate.
Inflation has already risen significantly higher than the Fed had earlier predicted it would.
A lot of consumers are very forgiving now because they're finally being offered parole from cabin fever.
Inflation is likely to run ahead of expectations, but I think it'll settle out at around 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Here come the downgrades from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Equity futures down 13. We declined slightly on the S&P 500. Goldman Sachs, Tom, first out the gate with a GDP downgrade.
And Vishy Tirvadur at Morgan Stanley goes the other way, mentioning Ellen Zentner with a calculation of a much more optimistic Q2. And I would assume that on to Q3, Q4. That's a decision, John, that makes people tune in August. Maybe we'll have more than 42 viewers and listeners in August.
Thank you for that, Tom.
Thank you.
Great promotion of this program there.
I'm working at it.
Here's the quote from Jan Hatzius and the team. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. They go on to say both now appear likely to take longer than we anticipated. How many other people, Tom, are in that boat?
Well, there's a lot of people in the boat, but I'm sorry, John. Morgan Stanley goes completely the other way.
We'll get into it with Morgan Stanley in a moment.
Economic recovery.
That's part of the market, Tom. That's the debate. I'm with you.
I'm in cash. I feel comfortable.
Well, clearly, you feel a lot better about yourself, given you're not participating in what we've seen on the screen play out in the last year. Are you done?
No, did you watch Ted Lasso?
Can I bring Lisa in? No, we're not doing that.
They're making jokes about the Dutch, John,
okay.
And I need you.
You take a drink, relax, take a deep breath, okay?
Tang.
Lisa,
even when they don't launch a rocket,
let's talk about the outlook. Clearly, risks are building for others to follow in the footsteps of Goldman Sachs.
The idea here, they really pointed to the return to the office and how that's really lagged behind. And Tom was talking about how office attendance remains at just 1/3 of pre-pandemic levels. Interesting, if you look at this note, there is a question about how much permanence this decline in office work really will be, that basically a much greater proportion of employees found that they could work from home more effectively and that it's proving to be stickier. But really, the proof will be when people go back to school, and I keep saying this, but I'm telling you, as a parent, it makes a huge difference in terms of your ability to leave home and actually focus.
You'll be proud of us. We talked about this all last week, and I think you're on the money here. It's a really, really important topic to discuss.
Yeah.
Because in September, the additional unemployment insurance expires, and many people anticipate the return to school to develop. Now, this is really important for how the supply side of this economy responds as well, Lisa, and I imagine that's going to be a massive part of the conversation, the debate over at the Fed this coming Wednesday.
This is a key reason why a lot of big companies, including a lot of the Wall Street banks, have pegged September as the date to restart and get people back to the office. office. There is a question of how indicative these statistics are showing the occupancy rate now, based on the fact that everyone is looking to that key September date to figure out what the new normal looks like, John.
Equity futures right now down 11, down 12 on the S&P. Let's whip through the price action. Negative 0.25%, a turnaround from where we were a couple of hours ago. Outside of that, into the bond market, yields pull lower just a little bit by another basis point in the last 30 minutes or so. We're down 3 or 4 basis points now to 123.95. Your euro just a touch stronger. Euro dollar 117.88. Euro dollar Lisa positive 0.14%.
Yeah, a bit of weakness today in the dollar. Just building on this idea of office occupancy, there's a question of how much traction the move to the suburbs has. And actually, we might get some read on that. 10 a.m. we get some new home sales. Last month, they actually unexpectedly declined based on how high the prices were. People bought fewer of them. Now the expectation is they will increase once again, and that this move to less urban regions continues. So how much does that give some steam to this idea that the work from home trend will remain in place for much longer than people had previously anticipated? This week, we do have a huge slate of Treasury auctions kicking off the week today at 1 p.m. with $60 billion of 2-year notes. I'm curious how much this says about what people are expecting from the FOMC meeting this week, culminating, of course, with that Wednesday press conference. How much do people start to ratchet back their expectations for a permanently dovish Fed, regardless of what happens with inflation? And then aftermarket, Tesla also kicking off a week of tremendous earnings, particularly among big tech names. And John, as you were pointing out earlier, a key issue will be whether they mention their relationship with China, especially in light of the new regulations, as China continues its regulatory crackdown of a lot of the most popular sectors in the region, John.
That's really shaking things up. And Lisa, thank you. The Hang Seng down by more than 4% at the close to kick off the week. The CSI 300 down more than 3%. Earnings season picking up big time as the week progresses, Tom.
That's the earnings front. Carl Riccadonna, always wonderful at Bloomberg Intelligence Economics. John, Biden's plan, according to Mr. Riccadonna, will be inflation light. That's like the champagne of bottled beers, Miller Lite.
Thank you, Tom, for that. Is this about addressing the supply side story?
I think so.
Is that what he's getting at? Okay, let's get to Michael Kushner, shall we? Morgan Stanley CIO of Global Fixed Income. Michael, part of the beauty of these conversations we have on this program sometimes is to get the Morgan Stanley view and compare and contrast that with another outfit. So let's talk about Goldman. Here's the quote. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. Goldman go on to deliver a 1 percentage point downgrade to GDP growth forecast for Q3 and Q4. What's the Morgan Stanley view at the moment?
Well, our view in investment management is that a slowdown of some degree is not necessarily a terrible thing for the economy as a whole, in that we were growing very, very fast, with at almost double-digit pace in the middle of this year. And obviously we can't sustain that, and there's large inflationary pressures which are making it difficult to discern the underlying trends in inflation in terms of how much is temporary, how much is permanent, or raising inflation expectations. So modest downgrades in growth, a little bit longer time frame in terms of getting back to normal because of the rise of the Delta variant and more uncertainty as to how people are going to behave with this greater uncertainty, the unwillingness to increase vaccinations meaningfully in the near term, all presage that what was seen in terms of a downgrade in growth expectations in the bond market, with yields falling significantly from where they were at the end of Q1.
Michael Kushner, this morning, just to get mathy, John insisted I do some math just to shut me up. And Michael, I did a 20-year regression of the 5-year real yield. I'm sorry, we have been in a trend of inflation adjusting ever lower. How do we break that trend?
That's absolutely true. It's been a combination of design policy to bring inflation down over the last 20, 30, 40 years. I remember Alan Blinder, when he was vice chairman of the Fed, talked about opportunistic disinflation as a way to bring down inflation in the 1990s. I think they've exceeded beyond their wildest dreams. But there's also been the underlying secular stagnation hypothesis of falling secular dynamics of economies bringing down that rate as well. I think what has to happen is that the Fed has to commit to trying to raise inflation by keeping monetary policy easy when things are good. This is the opposite of opportunistic disinflation. We need opportunistic inflation, which means as the economies do better, we don't respond to it, just as they over-responded in the previous periods. But most importantly, is that a policy error occurred in the 2015 through 2018 period. Inflation expectations collapsed, and we need to get at least back to where we were into the 2012, 2013 levels, which we're slowly getting back to. But that will be a challenge with inflation as high as it is today to convince markets they will not revert back to any kind of behavior they had prior to this pandemic.
Michael, faith in how much the Fed is willing to allow this economy to run hot. Another way of looking at this is, can real yields go more negative? They're already at all-time lows this morning as people look at inflation picking up, supply chain issues not abating, labor shortages not abating, and a Fed continuing to be dovish and pointing to the Delta variant. Is this a trend that has more steam? Could we see 2% negative real yields?
I think it can. If they remain committed, they will not change a monetary policy. You think about the mathematics of a 10-year bond yield. It's an accumulation of 1 year yields, 1 year this year, 1 year next year, 1 year going forward. So the longer they procrastinate or not raise interest rates, the more downward pressure there is on long-term rates today. We estimate that if the Fed 1.65% 10-year rate would be fair value if the Fed did what they said they were going to do, raise rates to the end of 2023. If in fact they procrastinate further, where yields are today are not unreasonable, considering if they procrastinate to 2024 to raising interest rates. So the more they push out with forward guidance, when they're going to and how fast they're going to raise rates, the more yields can stay low. If inflation's still high, real yields can continue to remain very low. Can they move a lot lower? I'm not sure about that because I think inflation is going to peak in the next couple of quarters.
Michael Kushner of Morgan Stanley. It's good to catch up, sir, as always, the CIO of Global Fixed Income. Just giving you some deeper insight into the range of views that we have on Wall Street right now about the outlook after Goldman delivered a downgrade to the US GDP outlook. With this line concluding things, Tom, for you, we expect growth to slow further to a trend like 1.5 to 2% by the second half of 22, a sharper deceleration than consensus expects. And one of the challenges that any bank has in the research department is to match that eco view, Tom, with your outlook for the equity market. Because if you believe in a sharper deceleration back to trend, what do you want to own in that environment in this equity market?
Well, the word is ambiguity, John. It can cut both ways. And I would say to a point, lower yields and everybody flips the ratio and, it's better and good for earnings. But besides the two-part nature of the equity market, tech and everything else, there's a point where the ambiguity clicks in and goes the other way.
You could make the argument the market's already there, Lisa. The market's ahead of some of these downgrades to the forecast that might materialize in the coming weeks. Yields are aggressively lower over the last several months. Real yields all-time lows, and the Nasdaq outperformance is there for all to see.
There's a question, though, about growth and inflation. Could you get a deceleration in growth with an ongoing inflationary pressure from perhaps this increase in demand and perhaps supply constraints that are ongoing, John?
Will those supply constraints ease in the way people anticipate in the back end of this year from September onwards? Huge question for Gene Tenuzzo, Columbia Threadneedle, Deputy Global Head of Fixed Income. Looking forward to that conversation. We're down 11 on the S&P. We're negative 0.26%. You have a bid in the bond market. Yields are lower by 4 basis points on 10s to 123.62. With Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. This is Bloomberg.
With the First Word News, I'm Laura Wright. China is lashing out at US policies in a tense start to high-level talks. Chinese diplomats handed their American counterparts lists of demands and declared the relationship between the two was at a standstill. China's vice foreign minister says the US is trying to contain China. House Speaker Nancy Pelosi has issued a warning. She won't back off her plan to hold up a bipartisan infrastructure bill until the Senate delivers a larger Democratic-only spending plan. Republican senators warn that Pelosi's strategy could threaten the deal. Bitcoin soared today and is now approaching $40,000. Some are attributing the rally to traders exiting bets on declines. There's also speculation about Amazon's potential involvement in the cryptocurrency sector. In the UK, the number of new coronavirus cases has dropped for the 5th day in a row. That's a potential boost for Prime Minister Boris Johnson. Following a chaotic week since the lifting of pandemic restrictions, Johnson's government has sought to encourage a return to normal life over the summer. It's dropped social distancing rules and done away with mandatory mask wearing. Banks in the Eurozone area are set to reopen the cash taps to investors. That will put them back among the region's highest yielding stocks to own. The European Central Bank said on Friday night it will let a cap on dividends and buybacks expire at the end of September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
We're about 90% of the way there. I'm here this weekend working on legislative language with colleagues and with staff, and I feel good about getting that done this week. We have one issue outstanding, and we're not getting much response from the Democrats on it. It's about mass transit. My hope is that we'll see progress on that yet today.
That is just a little hint, a flavour of the rural-urban divide between Republicans and Democrats. We'll pick up on that in just a moment. That was Senator Rob Portman of Ohio on ABC's This Week. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's the market, the price action this Monday. Futures, -11 on the S&P. We're down 0.2%. Yields in 4 basis points. Just a defensive posture here, slightly defensive. Yields back down to 123.45. Dollar showing some weakness, though. Euro some strength. Euro-dollar 117.93. Positive there, 0.2%. And crude on the back foot, we're down about 40 cents, Tom. We're negative 0.5% to $71 and about 70 cents.
Watching yield, a little fragile. I'm watching the 5-year inflation-adjusted yield. Usually I don't do that, but negative 1.1, round it down, negative. I can't even do it, John. The numbers are so unfamiliar. I could never do your show. Negative 1.92%. On the 5-year inflation-adjusted yield. John,
my producer's in my ear, Tom, saying, yes, we know. You could never do my show. That's right.
Thank you.
Carry on.
I don't even know how to frame that. Right now on infrastructure, let's get to it. Jack Fitzpatrick joins us here as a debate. We heard Senator Portman, outgoing of Ohio. Jack, we forget the ancientness of this. Part of this is Senator Schumer's Gateway project in New York, and they're talking about helping or replacing 110-year-old tunnels. Do the politicians understand how silly this is? Like, get to it?
They do seem to understand how ridiculous the debate for a few years now has been on Gateway. You probably recall there was a spending deal held up under former President Trump, seemingly because he knew the importance of that project to Senator Schumer. That one individually has been less controversial now than that broader issue of exactly what the ratio is going to be from highways to mass transit. That's the latest issue we've heard in these talks. But I think you could probably argue they understand how silly some of the issues in recent years have been, because they do seem to be setting things aside and pretty close to a deal at this point.
For our listeners and viewers, I mean, I read the Zeitgeist this morning, and I'm as confused as anyone. Where are you going to put your ear to? Which door are you going to put your ear on Capitol Hill today?
The ball is in the Republicans' court, in the Republican senators. The last we've heard, our colleague Eric Wasson just reported this morning that Democrats, sort of a combination of Democratic senators and the White House, sent along what was supposed to be a holistic check every box offer. So if there's an acceptance there from Republicans, we would have a deal. The question right now is, do Republicans have any problems with any individual thing that Democrats just sent them? So the Republican senators are the ones to watch right now.
Jack, earlier in the year, we were talking about how President Biden is looking to the population to provide him support, a bipartisan coalition of Americans supporting his infrastructure plan. If you look at some of the recent polling, it's actually showed a decline in his popularity as people are concerned about inflationary pressures. How is this being reflected in the conversations, if at all, down in Washington?
In the legislative negotiations, really the conversation about inflation has been very simplistic and more of a campaign talking point. I think you see some change in the president's rhetoric, talking a bit more about inflation, trying to avoid using the kind of words you guys might use, transitory, things that might go over a lot of people's heads, and trying to address the issue. But as it plays into legislation, there's a real partisan divide just over the role of spending and taxing in this recovery from the recession. So, there's understandably a lot of opposition from Republicans where inflation concerns kind of get mixed in with just a regular old partisan divide.
Jack, surveillance correction, we do try to steer clear of transitory as well, because it is a drinking game here. And if things get a little too heady on a Monday morning, then it sets up the rest of the week perhaps a little bit poorly. There is a question, though, going forward. You talk about the willingness to borrow and spend at this moment as we try to recover from the pandemic, and yet we still are facing that debt ceiling limit, this potential for a U.S. default. How serious is that? I mean, is there actual pushback against this borrowing and spending that seemed to be the way of the future just a few months ago?
Well, the debt limit talks look very difficult right now. Of course, that's not really a conversation about the taxing and spending that happens. It's just the means of paying the bills that have already come due. But it does look like there's a lot of Republican opposition. The comments last week from Senator McConnell saying he didn't think any Republicans would support a suspension or increase really ramped up that fight. We are going to see a Republican proposal from Senator Lindsey Graham, who's a top budget committee member, saying he wants a commission of some sort to look at Social Security and Medicare. But really, it looks like Democrats are probably being pushed toward a path where they go it alone through the reconciliation process, which would be politically tough for Democrats because they really would have to own that entirely on their own rather than having a bipartisan deal where everybody takes the blame. So that's the next thing to watch, although the deadline is tough to predict, as we've heard from Janet Yellen and others.
Jack, anything on the agenda in the diary about addressing this surge in COVID infections in this country after Dr. Fauci was out on the networks over the weekend suggesting there is an active conversation about revised mask guidance?
Everyone is all ears over whether there's going to be new mask guidance, new guidance on maybe a second shot, a different dose for people who have gotten a Johnson & Johnson vaccine. I think politically there's clearly some nerves when it comes to just determining how much of a bump in the road this is to reopening. But there's so many unknowns that, when you talk to members of Congress, when you talk to people in Washington, there's as much confusion right now about how significant this increase in case counts due to the Delta variant is and how long it will last as there is with the rest of the population.
Jack, it's good to hear from you down in Washington. Bloomberg Government's Jack Fitzpatrick. And that conversation, Tom, part of the broader one for this market and for economists on Wall Street at the moment. To what degree will this full recovery in this country now be delayed?
Well, it's going to be delayed, and there's a lot of different opinions, John. I just don't think we know. And what we're going to hear Wednesday from Chairman Powell is simple. They are massively, massively data dependent. I can't emphasize that enough. And that's a data dependency overlaid with the new stew of the pandemic.
You'd have to imagine, Lisa, that Goldman's out early and others are going to follow. And also just how early this is. We'll talk about that in a moment when we get to the price action.
And I wonder how much people are going to start to talk about demographics. I mean, over the weekend, we got that the U.S. population rose at the slowest rate ever in the past year.
We've got some problems, haven't we?
Well,
Welcome back, Lisa. Just to shine a light on some of them. On the equity market, down 11 on the S&P, negative 0.2 of 1%. With Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your equity market, just a little bit softer. Treasury's firmer, yields lower 4 basis points to 123.29. Heard on radio, seen on TV. This is Bloomberg Surveillance. Live from New York City for our audience worldwide on TV and radio, here's the price action this Monday morning. Equity futures slightly negative, down 0.25% on the S&P 500. On the Nasdaq, down by 0.1%. Your headline for the last 45 minutes. Goldman Sachs downgrading the outlook for US growth. The full service sector recovery delayed. So what have we got? A 1 percentage point downgrade for Q3 growth in America, for Q4 growth in America, and back to trend, 1.5% to 2% GDP growth in the back end of 22. That's a sharper deceleration. That's the call from Goldman. So here's the question for investors. What are we seeing play out here? Goldman early out the gate. Is this for a move yet to develop or a move that we've already seen? Let's talk about that. Year to date, switch up the board, the Russell versus the Nasdaq. If growth is going to be scarcer than you anticipate, you would expect the growth equities to outperform. And more recently, that's what's happened. We're also seeing that play out on the year now. Year to date, the Nasdaq up by 15 percentage points, the Russell up by 11, 12 percentage points. So a little bit of outperformance on growth equities. That's what you'd expect if we were starting to talk a whole lot more about quicker, faster, sharper deceleration and downgrades to the outlook for US growth. Let's go one step further, switch up the board and get to the bond market. Record low real yields on a 10-year real yield, and your nominal yield right now is pinned beneath 130 at 123.79 after having a little look at 112 last week. So yields are in again, 3-4 basis points on 10s. The curve is flatter. So, Tom, I think this is the debate right now. Goldman's first out the gate. It's leading the economists. Maybe we'll see more, but this market moved first. And I think that's the conversation we've got to have. Is the market already there in a way that the economists were not?
You bring it right up. And let me start with you instead of Seema Shah. John, to me, it's the expectation of fixed income market and that we all understand stocks expect out. How far out does fixed income expect?
We're going to have that debate, Tom, in a moment. Yields 123.79. Before we get to Seema Shah, we have to get to Katie Lyons, Tom. You know the order of things. I did the market check.
I'm new at this.
Stocks.
I've been off 2 of the last 3 weeks.
I didn't mention China.
Moon River.
Let's talk about China.
Who are you talking
Katie
about?
Lyons. Morning, Katie.
Good morning, John. Yeah, let's talk about China, specifically those Chinese education companies listed here in the U.S. Yes, they were pummeled in the Asian session after China over the weekend banned them from making profit, banned them from going public if they aren't already, and banned them from raising capital. That was reflected in the Asian equities, and it is reflected in the U.S. ADRs this morning. Just take a look at New Oriental Education, down 24% this morning after falling 54% when this news was originally reported on Friday. Our analysts here at Bloomberg Intelligence say the new rules from China could mean an 80% decline in sales for New Oriental as well as TAL Education, which is also down by about a quarter this morning, as is Gaotu. And other Chinese companies listed in the U.S., not necessarily in the education sector, are also under pressure. The fear is that this clampdown is going to lead to other industries. We already know it has come for DD Global, which is down another 12% today. One basket of stocks moving to the upside, though, is basically anything tied to crypto. Bitcoin nearing 40,000 once again at the highest level in over a month. And that is leading to a big boost for some of those crypto-related equities. Riot Blockchain, Marathon Digital, each up around 18%. MicroStrategy getting a nice lift as well. And Coinbase Global, the exchange, Tom, up about 6% at this point.
Okay, thanks so much. We've been talking about economic views and maybe the nuances of a house for fixed income strategists is one says tomato and the other says tomato, and they sort of move on from there. Seema Shah joins us right now with Principal Global Investor. Seema, do you care about the nuance of economists right now and how yield expects out?
I think we have a technical problem with Seema Shah, Tom. We're going to re-establish that.
Sorry.
Principal Global Investors Chief Strategist Seema Shah will be joining us very shortly. Tom, I'm with you on this call, so let's sit on it for a moment. I talked about it minutes ago. I can summarize it as follows from Goldman. And here's the quote from the team over at Goldman, led by Jan Hatzius. Quote, in the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated.
Yeah.
So Goldman's put some numbers on it, Tom. A 1 percentage point downgrade to Q3 and Q4, and a return to trend of 1.5% to 2% in the back half of 2022. And it's that sharper deceleration that they now expect. So the conversation that I think we need to have on this program with market participants is that fuel for a move in this market that we have yet to see? Or does it reinforce a narrative that is largely already played out in this market, looking specifically at bond yields, Tom, both nominal and real?
I think you've got to partition, John, bond yields, which is what I was doing there before we went to Ms. Shah. The idea of bond yield expectations versus equity, which is a separate beast. And, you know, it's not that I'm in the camp with David Rosenberg or Steve Major, but you wonder, how do you get to the yields they're talking about? And you do that with that second half view. Maybe that clicks in May of next year.
Sharper deceleration, Lisa, if that becomes a bigger theme, And I think it's become a theme. Let's be clear about that over the last couple of months. You wonder where we go from here.
There's also a question about how much bond yields actually reflect what you were talking about, which is a slowdown in growth. How do you partition, to use Tom's word, growth versus inflation? Because they are not synonymous. What happens if you get a growth slowdown, but you get more persistent inflation because you don't have people come back into the workforce and there isn't the productivity boom that people are expecting, even though you do see demand increasing based on all the cash that people have, at least for things that they can and that are COVID-proof? John, these are some of the questions that really raise an issue, especially if the stock market is being boosted by these low bond yields.
Are you just trying to tease out a conversation about stagflation? Is that where you were going? Is that what I heard?
Doing?
Is that where you're going? Where you were going, Lisa? Just a little bit.
Idea here.
You were saying it without saying it.
I mean, I was describing it, which I think is fair. I think this is the concern. And look, 8% GDP growth is not stagflation, but we're setting up the dynamics for a concern.
The dynamic here, Lisa, is you're incoherent because you've been hanging out on the pendulum of loons and bears.
I'm not incoherent.
Give us a bear story here. Give us a bear story.
I can give you.
I think we just got one, didn't we? Go on, Lisa.
Well played, John. Good job. Look, I'm not going to give you a bear or loon story because we have basically a huge week ahead of us, and nobody really wants to hear about the loons in Tupper Lake, which were beautiful, by the way. Really, we're having loon calls.
No, I think, look, let's get serious for a moment. If we can on this program, we have 3 hours of it. Let's just spend 5 minutes being serious.
Be serious.
The supply side of this economy and how it responds from September onwards sets the tone for so much, including for the Federal Reserve. This Federal Reserve has been so vague about what transitory means, about what substantial further progress means. They've been very vague about it, and I think some of them believe that that's a feature, not a bug. Vice Chair Clarida came the closest of anyone on that Fed board to describe the argument, and when we get a resolution to the argument, when he came on this program several months ago, Tom, and said, we'll know probably likely, and I'm paraphrasing, at the end of the year. You've got to wait for that data, September onwards, to see how the supply side of this economy responds. And if it does not respond, Tom, in the way that some people anticipate, then maybe Lisa's little bear argument over there gets a little bit more
argument.
fuel. All right?
I get it. Well, we tried to be serious as well. I would suggest, with great respect, John, I want you to bring in Seema here, but I would suggest that what we're really talking about is a Federal Open Market Committee that is more ex post than we've ever seen. John, they're going to wait and wait and wait.
Yep. Seema Shah joining us now, Principal Global Investors Chief Strategist. Seema, our apologies about the technical connections. Just having this debate here about this call from Goldman Sachs, this sharper deceleration that they now expect, and the idea that we've delayed a full service sector recovery. Are you in line with that call as well, Seema?
Hey, Jonathan. Well, we can definitely see that there's a deceleration in the second half. I don't think we're going to be looking to revise downwards our forecast. I think, most of the street all had a peak growth in Q2 is absolutely right. Now, there may be a few tweaks coming here and there, especially as we start to understand that, as we've seen from the Delta virus, that actually continued mask wearing, continued restrictions, and more than anything, probably a lack of COVID confidence, which is going to be weighing on some consumer behavior going forward, may start to weigh on growth expectations. But I have to say, I agree with your point before, which is that the market has probably foreseen this. And that's what's been driving some of the move over the last month, both in the equity market and in the bond market.
Seema, when you say the market, please be specific. Are you talking about the bond market or the stock market, or are both reflecting that reality?
I think both are reflecting reality. I think the bond market has got the added issue of what is going on in the Fed's mind, which I think everyone is very much confused about. And really Wednesday, more than anything, is going to be a really good opportunity for them to clear up a lot of the confusion that's there in the market. But absolutely, I think the equity market and the bond market have been looking and seeing that growth is going to be decelerating a little bit from the first half of the year.
What do these record real yield lows mean? Ever greater negative rates. What do they mean? Not for the fancy people. What do they mean for our listeners and viewers who've got to live with this fiction?
Yeah, look, it's a concern for savers. I think that's for the normal household out there. That's a real concern. But I think that, look, we have to look at not just focusing on the short term, but what is going to go on the long term. And I do think the market has really overreacted. We all knew that peak growth is going to be hit in Q2. This is just so the market is going to absorbing it. And then once it's realized that actually it's slowing to a sustainable rate of growth. which is still a very impressive rate of growth. And then we should see equity markets both stabilize in terms of the cyclical, the value rally, and we should see bond yields start to rise as well.
Seema Shah, going to catch up with your Principal Global Investors Chief Strategist. And Lisa, you asked the question, didn't you? Which market, bonds or equities? And Seema said both. And I think you've seen that, small caps versus the Nasdaq more recently. You've certainly seen it in the bond market, that's for sure, both nominal and real.
What I was thinking about is the fact that real yields and low yields just fuels the move into stocks because they actually give you some value. So it's sort of this conundrum that the more growth expectations slow, it could be even better for equities because that means that there is that much more cash that has nowhere else to go, John.
This is something we've been talking about now, Tom, for a while. And it's interesting to me that Goldman are as lonely as they are on this call and that others haven't followed looking out. We've talked about the increased possibility of downgrade risk, and we started the program like that with RBC's Laurie Calvasina earlier this morning. There are enough things piling up now to suggest we'll see a lot more of the same.
Well, there's clearly downside risk in a partitioned market. Apple and Amazon aren't the rest of these companies struggling.
But levels versus rate of change, Tom. 8, 7, 9 down to 8. 8 down to 7, 6 down to 5.
Go to cash.
The age-old rumor.
It seems to be rate of change that's driving things, but we've still got to talk about some stunning levels too.
I agree strongly. You sound very old world, very British.
Thank you, Tom. I'm
very
trying.
British.
We're down 6 on the S&P, down a little more than 0.1%. This is Bloomberg.
With the First Word News, I'm Laura Wright. The White House is shifting the way it talks about inflation. Polls show there's increasing voter concern about rising prices, and Republicans are trying to use the issue to kill President Biden's plans to spend trillions on social programs amid infrastructure projects. Democrats plan to have the president use plain language explanations and assure people the price hikes will fade in time. Don't expect those labor shortages in the US to go away anytime soon. According to a survey of business economists, only 6% expect the shortage of workers to ease off by the end of the year. Nearly a third of those responding to the survey say they don't know when the problem will be resolved. The survey was conducted by the National Associations for Business Economists. China has announced a broad set of reforms for private education companies. It wants to decrease workloads for students and overhaul a sector it says has been hijacked by capital. Education companies will be banned from making profits, raising capital, or going public. That sent shares of edtech companies plummeting. The world's largest maker of semiconductors is considering whether to expand. Taiwan Semiconductor chairman Mark Liu told shareholders the company may be building a chip-making plant in Germany. That's in addition to the one TSMC may build in Japan. Chip makers have been cranking up production to deal with shortages that have hammered automakers and other customers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg.
We will continue to have attractive fares for customers this summer. The ancillaries, I believe, will continue to do well. And when we get into the fourth quarter and more likely into the first quarter of next year, summer of 2022, I think you'll see a rebound.
Ryanair looking for a profit this quarter. Neil Sorahan there, the Ryanair CFO. That stock up by more than 4% over in European trading. From New York City this morning, good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Counting you down to the opening bound, we're shaping up as follows. 1 hour and about 42 minutes out. Equity futures down 7. We're negative 0.16% on the S&P 500. Well off the lows of earlier this morning. Yields off the lows of the morning as well. Still negative, still down by 3 basis points on 10s, Tom. 124.45. And the euro just a little bit stronger here. Euro dollar up by 0.2%, positive 0.2% on that currency pair. Stronger euro, weaker dollar. That currency pair, Tom, 117.95.
John, watching the VIX, 18.34. I'm going to call that sort of middle gloomy range. Not too bad, actually. Up a stick this morning. Right now, it is certain there will be a question on a conference call, and either Mr. Cook of Apple or his CFO will answer it carefully. David Wilson's out front of the simple question about Apple in China, and for Chinese stocks, David Wilson, it's not going well.
Oh, no, absolutely not. And if you really want to see how badly it's going, just look at these online tutoring companies
that all use Apple computers.
Well, they might well. I mean, consider that, those stocks, the American Depository Receipt specifically down 60% plus on Friday on anticipation of government action against the industry. And you're getting further declines today of more than 20%. Now that the government has moved, they basically said these companies can't be profitable. They have to be nonprofit. They can't have international investors. There are a bunch of other restrictions that they put on the industry, but really it's kind of just taking the heart out of the business for these companies.
Right.
And, it's part of a broader trend that we're seeing among Chinese ADRs. Bank of New York Mellon developed decades ago indexes to track ADRs. S&P now runs them, but, we're talking about the S&P BNY Mellon China ADR index. It is down 46% relative to the S&P 500 since February.
Okay, Dave, before you move on from the tutoring companies, Tom, this to me actually made me think of you over the weekend, because the issue was a lot of the Chinese officials were concerned about how much parents were spending on their children as a deterrent to having more of them because of the population, that basically the pressures were too high on the kids and the bills were just too darn high. And for some reason, Tom, that made me think of you and the tutoring bills
tutoring
that you talk about sometimes.
Yes, the rest of it. Tutorist David Wilson on the ADRs, I believe below $5 a share or maybe $4 a share, institutional managers get a phone call from the general counsel, you must sell. Is that happening?
Yeah, no doubt it is at this point, and probably with the tutors started happening on Friday. But it's not just that business either. Tencent Music Entertainment, so we're talking streaming.
That's like a real company.
Yeah, absolutely. It's a unit of Tencent Holdings, a much bigger company. But the government told them, your exclusive deals with labels for songs, no, you can't have them anymore. So they've got 30 days to rewrite those. Tencent Music taking a hit in response. I mean, we're seeing declines across the board in this group. So that 46% drop since February for the ratio to the S&P 500 is going to get bigger for sure, once trading begins today.
Dave, some money managers saying that Chinese equities are becoming uninvestable because of this regulatory uncertainty. It's unclear where Chinese officials are going to crack down next, if they're willing to go after some of the biggest and most successful of their industries. Is there some sort of coherence behind some of the regulations that are being rolled out, or some sort of guidepost with respect to how the Chinese demographic is changing?
Well, I mean, what it comes down to is, the government's really trying to get, its arms around these companies. They have so much data in a lot of cases. Think about DD Global as far as that goes, an ADR that's now down more than half, basically, from where it was sold just last month when that company went public. But these are the kinds of issues that are coming up in terms of the enforcement actions. It's all about kind of reining in a whole lot of companies, especially those that have plenty of data that the government would love to see.
For those of you on radio, very important to understand, David Wilson, he's tanned and rested. This is a big week. Is this the biggest week of the biggest week, or is it sort of kind of like biggest week?
It's the biggest week. I mean, you've got companies that amount to about half of the S&P 500's market value.
Half of the market this week.
48%. They're going to be reporting. I mean, starting with Tesla after the close today, tomorrow, Apple, Microsoft, and Google's owner Alphabet. Wednesday, Facebook. Thursday, Amazon.com. Yeah, it's going to be a big week for sure.
David Wilson, thank you so much. Greatly appreciate it as well. John, what are you looking at? You're looking at like the Chinese stuff.
DD pre-market down by more than 11%. I'm pleased Dave Wilson brought it up. We're trading at 7 on DD in the pre-market, Tom. We IPO'd at 14. This is a $67 billion company that's been cut in half over the last several weeks. And Lisa asked the right question, Tom. Just how investable are some of these companies, given the environment we're in right now? Look, over the future, over a longer time frame, it might make sense for some people in the near term. There's some real risk in the near term.
Okay, the risk to me is not our listeners or viewers. The risk to me is a litigation stream here towards Western Wall Street. That I'm not blaming them, but they've gotten run over by this.
No, you're raising questions about the questions other people will be asking, Tom. What did the company know, and when did the company know it?
Exactly.
Did they anticipate that this kind of regulatory clampdown was coming? And Lisa, if they did, why wasn't that disclosed before going public and tapping U.S. capital markets?
This is a different China, and Xi Jinping is facing a very different demographic than he did, say, 10 years ago. And there is a question of how much they will emphasize a transition to a more sustainable growth over the rapid growth, over the capitalistic emphasis earlier. And this is the key question in my mind. Is there coherence behind some of these crackdowns? Is there a move away from emphasizing success in the traditional capitalist way? And does this lead to more moves like this that pull people away from China and those investments?
This is about the party over individuals. And everywhere you look, that is what this is about. Whether it's Didi testing the patience of Beijing, whether it was Jack Ma testing the authority of Beijing, whether it's some of these companies trying to educate the Chinese, Tom, this is about party over individual and aggressively pushing back against anyone that's willing to test it.
I agree it's a story, and we should stay on it. But, John, to me, the massively larger story this week is, given the pandemic, given the uncertainty on Delta variant, what do corporations decide to do in cash? And the answer is they're going to delay.
Delay what, Tom? Buybacks, acquisitions?
Dividends, buybacks,
capital
acquisitions.
returns.
They're just going to say, wait for October, wait for September, et cetera, et cetera.
We'll see. Jul.26 is going to join us next. Columbia Threadneedle, Deputy Global Head of Fixed Income from New York City this morning. Good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your price action set up as follows. Going into the Monday morning opening bell, we're down a 9 on the S&P. We're negative 0.2%. Into the bond market, yields are in 3 or 4 basis points on 10s to 124.12. 1.24% on a 10-year. Euro dollar just slightly negative here at 117.95. Negative 0.2% as Goldman comes in with the headline of the morning, downgrading the outlook and delaying the full recovery from goods to services and looking for a sharper deceleration. That call sets the stage for this debate in this market this morning on this program. Heard on Bloomberg Radio, seen on Bloomberg TV. This is Bloomberg Surveillance.
Already in that decelerating upward revision pace, and about half the sectors are contributing to that right now.
You have a natural just sort of slowing in sequential growth. You're not going to keep growing at 10%.
A slowdown of some degree is not necessarily a terrible thing for the economy as a whole.
A lot of consumers are very forgiving now because they're finally being offered parole from cabin fever.
Inflation is likely to run ahead of expectations, but I think it'll settle out at around 3%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's a simulcast, the team complete. Thrilled that Lisa's back with us this morning on radio, on television, in not a boring week. John, market dynamics, the opinion of many on Wall Street gets us ready for that Fed meeting.
Well, let's start with Goldman. Quote, the scope and timeline for a full rebound and the implications for the growth outlook. For the full rebound, longer. The scope for the outlook, Tom, the outlook at least means lower growth, deceleration sharper. And what does that mean for this equity market? Clearly, this is a market trading on rate of change. And the Goldman call this morning, the downgrade to the outlook, reflecting those fears.
Yeah, and the Hotsias-Zentner axis here, the polarity between Jan Hotsias at Goldman Sachs, John, and Ellen Zentner at Morgan Stanley. We can add 20 or 30 others into this debate. It redounds right over to the market. Mike Wilson, Zentner's colleague, says, look, the street says buy.
Yeah, but buy what? Buy what? He's looking for stability in earnings, Tom. That's why he upgraded consumer staples, downgraded materials. And this is the difference between the economists and the market participants. The economists are still looking at solid levels of growth. The market participants are focused on the rate of change from one quarter to the next, from 1 year to the next, Tom, from 22 out to 23. And if Goldman is talking about second half trend growth, 1.5 to 2% GDP in second half 22, and a sharper deceleration, okay, the economists might talk about really strong cumulative gains and strong levels of growth. This is a market, and it's not for me to say what the market should trade on. It's what it is trading on, and it's trading on rate of change and has been for quite a while now.
And Lisa, the backdrop of all this is, I would say Goldman is pretty lonely with a 2% sub view out, 14, 15, 18 months as well. Everyone has to adapt to that, including a Fed on Wednesday.
I was just thinking, how is the Fed going to speak to the fact that, yes, people are downgrading their view, but we're still talking about an 8% GDP. And frankly, this is not the same as inflation. Inflationary pressures persisting. And I got to say, as we see all of the 2Q earnings, we continue to see these inflationary pressures continue to build. We don't see an end to the semiconductor shortage. We don't necessarily see an end to the labor shortages, which are not closing as quickly as people expected, even with some of the enhanced unemployment benefits rolled back, Tom.
In the last 2 hours, relief in the real yield space, the inflation-adjusted yield, to go through the math, the nominal yield, the regular 10-year, less the inflation expectations gives you the residual. John Ferro, that's the real yield, and those were stunning numbers 3 hours ago.
And for many people in this market, the market is already there. Lisa's discussed it, you have, and I will now. The market's already there on both nominal and reals, and within the equity market, the outperformance of the Nasdaq reflects that. And if you want to make it really, really simple, if growth becomes scarcer, Tom, people are willing to pay up for growth. And that's what's happened with the Nasdaq over the last couple of months, never mind the last couple of weeks.
John, I'll let you do fixed income. I'm going to note in the dollar, I got a dollar churning today. Euro off the Lagarde party of last week, 117.94. Not much going on there.
Down 8 on the S&P. We're negative almost 0.2%. To Tom's point, the Treasury market is bid. Real yields, all-time lows earlier this morning on a 10-year maturity. On a 10-year maturity on a nominal yield, 124.79. Yields in, Tom, 2 or 3 basis points.
Yeah, it's about where we are. I also know BitDog with a run to 40,000. We're not there yet, but that's fired up the Bitcoin crew after 31,000, even 29,000 a bit away. Right now, we get an overview here of fixed income and how it folds into investment. Gene Tenuza has been doing this for years at Columbia Threadneedle, their global head of fixed income. Gene, good morning to you. What have you changed in your view in the last week?
Hey, good morning, Tom. Thank you very much. I think there's an important element here, which is a common thread to the change in the economic forecast you talked about from Goldman, which is we need to be thinking about what is that trend rate of growth after sort of the deceleration. And the deceleration that we're seeing, while we may have expected it, it is coming a little more quickly because of the rise of this Delta variant. So I think the Delta variant's been our focus. It's an early statement, an early sentence in the Fed statement that the course of the economy will depend significantly on the course of the virus. Unfortunately, that virus has taken a negative turn, and we suspect that the Fed's path toward tapering has also been delayed.
Markets can't wait for economists over at Goldman to tell us, Gene, and I say that with the deepest amount of respect to Jan Hatzius and the team, who I love catching up with. But this market's already got the scent of this, hasn't it? This market's well ahead of this story. You look at the trajectory of bond yields since we topped out at the end of March and what's been happening within the equity market. Doesn't it just speak to this narrative that's already there, already been priced?
I think the bond market is there, John, but I think we have to differentiate between the near term and the long term. Goldman's talking about something that's, a year and a half away from now. But the Delta variant is here right now, and that's what's impacting the growth outlook for the rest of this summer and what's likely to impact the Fed's tapering decision and the logistics around that. I think when we get past that, and we will, then we will have a window where actually the outlook for the Fed is a little bit trickier because we will see ultimately some reacceleration in growth. And as we get towards the end of the year, if there's not as much slack in the labor market, inflation could still potentially be stubbornly high. So we're kind of looking at the situation we're in right now in the bond market very similarly to the summer of 2012, where real yields were making new lows at that point in time. But there's room both from a growth upside surprise standpoint and a Fed outlook standpoint as we get past the near-term issues for yields to continue to move higher.
How big of a sell-off are we talking about in treasuries?
Well, we're still looking, Lisa, at 1.5% to 2% by the end of the year. There are still some dependencies there. And of course, we need to remain on track in that reopening and see that tangible transition from goods demand to services demand. But I still think that's very much in play. And it's not unusual that after we had a 125 basis point sell-off from last August until March of this year, that we'd see some retracement. So we wouldn't be surprised to see that 10-year retrace down closer to 1%. But I do think as we get past Delta, we'll be in a better place and a higher yield environment for fixed income.
Gene, I think you're touching on something so important, just the mechanics of an economy and how it rebounds, particularly this rebound. Peak rate of change is bound to come really early in the cycle. Peak yields don't have to come with that. The pushback you might get, though, Gene, and I can characterize it as follows, that we've added so much debt to this economy that our tolerance for higher interest rates is so much lower this time around that you may have a tighter timeline between where the rate of change peaks and when the yield curve peaks and when nominal yields peak as well. What would you say back to that?
Well, I think it's a good question to raise, John, but I think we have to remember where that debt is located. A lot of the debt that was issued by the federal government to fund the pandemic relief really took the burden off of consumers, off of homeowners, and even on the corporate side, where we've seen a lot of gross issuance, we've also seen corporate cash balances go up, and increasingly we're seeing companies use that cash to pay down debt. So really it's a government issue more than it is a corporate or a consumer issue for this year anyway. And I think, how that impacts long-term yields should ultimately add risk premium to the curve, but we're not seeing that now.
Gene, the technology companies that report this week have absurdly low levels of debt on their balance sheet. It's a cultural thing of Silicon Valley. I get it. What kind of pressure are they? What kind of pressure do they have from their financial people to do debt issuance to buy back shares?
Well, we've certainly seen it over the last decade, Tom, and we've seen that sector be a growing share of the investment grade credit universe, for example. But we have to remember that the technology universe is one in which there was not a lot of debt, a decade or two ago, because there wasn't a lot of cash flow, and that's very different now. And cash flow is very strong in a lot of these companies. So I would expect that, they would continue to sort of mature their balance sheets, and you will see usage of debt to fund all kinds of shareholder-friendly activities.
Gene, good to hear from you, sir. As always, Gene Tenuto, Columbia Threadneedle Global Head of Fixed Income. The credit side of the equity story that develops through the week. Huge amount of earnings coming through this week. Apple, Microsoft tomorrow, Tesla after the close. Tom, I would love, and I know you and Lisa would also love, a panel right now between Jan Hatzius and David Kostin at Goldman Sachs, just to take that eco call and then work out from David Kostin how to apply that in this equity market right now, because he came out with a note over the weekend, still sticking with some of these cyclical areas of this market, still sticking with them. So I just wonder what they think that economic call translates into a market call for this equity market in America.
I think there's a great tradition here, and some people will say, wait, you got an economist who's cautious and a strategist who's going the other way, but that is not unusual, John. The lovely panel I would like to see right now would be Jan Hatzius and Ellen Zentner. I think there's some real nuances between those two houses, calls, and there's many other houses as well.
David Kostin going into the weekend running the following, Lisa. Investors are concerned about the impact on economic growth from the Delta variant, but the new strain should not pose a major market risk. And I imagine most of the team, I'd assume most of the team agree with that this doesn't have to translate into a major market risk, just somewhat of a risk.
How many years have we been talking about Goldilocks? This is another case of perhaps Goldilocks persisting. Michael Kushma of Morgan Stanley saying it's not necessarily a bad thing to see growth moderate. If you have yields stay where they are, what is to pressure stocks downward, right? I mean, basically, why not go to where earnings are going up and pay for the revenue income that you're getting there and not, frankly, from treasuries?
Go on, Tom.
John, do you want to make 43% in the market?
I'll take that. Where's it coming from?
A bit ago, Citigroup went long donut, Krispy Kreme.
Okay.
And their original glaze. They say this is a new business plan.
Thank you for the single name call, Tom.
It's a single name call?
Citi.
Are you hungry?
Oh, he must be.
Is this... We're both speechless. How do you pick up from that one?
I don't know. Is that a pick-me-up, Tom? I don't know. Get a drink that requires a donut?
We bring quality research to you.
Thank you. I need to sit next to you. Sitting away from you. Just need to work out where you're going sometimes.
We need to all be in the same room together with our dozen Krispy Kreme donuts.
Down 6 on the S&P. Negative and more.
Okay, 2 dozen. I'm sorry, Lisa.
Yields are 124.95 on 10s. Heard on radio, seen on TV. With all the research this morning, apparently.
Donuts. Why don't we have a plate of donuts here?
This is Bloomberg.
With the First Word News, I'm Laura Wright. China lashed out at US policies in the first high-level talks between the two countries in months. Chinese diplomats handed their American counterparts lists of demands and declared the relationship between the two was at a standstill. China's vice foreign minister says the US is trying to contain the Chinese. The State Department says it welcomes competition between the two, but does not seek conflict with China. The White House and Democrats have moved to reach a compromise with Republicans on that $579 billion infrastructure package. Bloomberg has learned that last night they made an offer covering all outstanding issues. Among those items, funding for highways, bridges, water, transit, and how much unspent COVID money can be used for infrastructure. There's a time crunch involved. Congress goes on a 5-week break August 9th. The Swiss automation company ABB has agreed to sell its Dodge mechanical power transmission division to Connecticut-based RBC Bearings. The price, $2.9 billion in cash. Dodge had roughly $600 million in revenues for the fiscal year that ended in June. The sale indicates ABB CEO Born Rosengren is making progress on overhauling the company. Banks in the Eurozone are set to reopen the cash taps to investors. That will put them back among the region's highest yielding stocks to own. The ECB said Friday night it will let a cap on dividends and buybacks expire in September. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
I do not think that this crackdown will kind of mitigate the dynamism in the Chinese technology sector and entrepreneurial spirit. Don't forget, there's only one way for China to continue growth, which is innovation and technology. And with the recent backdrop, it's going to have to do it on its own.
What a timely conversation with Kyu Jin, the LSE Associate Professor of Economics. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Here's the price action this Monday morning, going into the opening bell 1 hour, 12 minutes away. Futures down 6 off the lows of the session, negative 0.15%. A bid in the bond market off the lows of the session. Yields come in a couple of basis points on 10s to 125.12. Euro stronger, dollar weaker, euro dollar 117.89, positive 0.15%. If I had the board of China, Tom, it is ugly to kick off the trading week. The Hang Seng down by more than 4% in Hong Kong. The CSI 300 on the mainland down by more than 3 percentage points. Not pretty to kick off the trading week over in Asia.
The hallmark of Bloomberg surveillance, as John and Lisa know, folks, is to talk to experts. We have that from the professor from the London School of Economics, and we are absolutely honored this morning to bring you David Goldman with his tenure at Bank of America, definitive on cross-asset analysis. He was way out front on the crisis of 2007 and 2008, and at Asia Times is their business editor now, a student of the philosophy and realities of China. David Goldman, is President Xi redoing Mao?
President Xi is not redoing Mao, but he is taking an important populist turn. Remember that the Chinese college entrance exam, the Gaokao, is the great equalizer of Chinese society. Everybody has a shot at it. If, however, you have massive resources put into private tutoring, in a situation where the average Chinese family already spends a year's pay on tutoring, you create a privileged class of rich people who have a much higher chance of getting their kids into a top university. So by forcing tutoring into nonprofits, he's effectively saying we're leveling the playing field. There's a broader aspect of this. Look at Meituan, which is one of the worst performers, down 14%. That's because the government said you're going to have to pay your drivers minimum wage at least. So it's wiping out the pool of cheap labor. In effect, the Communist Party is saying we don't want a situation where half the Chinese are ordering from restaurants and the other half are delivering the food. So it's a populist appeal to the less affluent Chinese, and I think kneecapping some of the billionaires who are a source of jealousy. is also going to be a popular measure.
David, you and I spent a wonderful lunch at a G7 meeting 400 years ago. I think Washington was president. Maybe it was John Quincy Adams. It was a long time ago. And David, we talked about how these governments get overcome by events. What are the events that are overcoming President Xi right now?
Well, remember that Graham Allison of Harvard, who wrote a very
wonderful book.
Yeah, a wonderful book about the risk of a U.S.-Chinese war, said that American chip sanctions against China are the equivalent of the oil embargo against Japan in 1941. That, of course, led to Pearl Harbor. The difference is that Japan couldn't invent oil in 1941, but the Chinese can produce chips. The events which Xi is addressing is that China now feels confident in self-sufficiency, at least in the workhorse, older generation kind of chips in the 14 to 28 nanometer range. Their national self-sufficiency program has proceeded much faster than the West expected. So they feel much less vulnerable to the United States, and they're throwing down a gauntlet to the U.S. saying, stop coalition building against China. And the foreign policy aggressiveness is entirely consistent with the domestic populism. It's all part of one policy, which is China is going to be a tech superpower, but in a way that benefits ordinary people and not just a few billionaires with unicorn IPOs collecting network effects on the internet.
David, you said something interesting, that these are displays of confidence by the Chinese party, that by the PBOC, by the regulators. And yet some people are saying it's actually a sign of insecurity because there needs to be this appeal to a populist kind of feel. There needs to be appeal to masses that have been left behind by an upsurge in the capitalistic side of China that has really benefited the uppermost class. At what point does this actually exemplify weakness and not strength in terms of Xi's ruling power?
Both are true, because China has always been ruled by a technocratic elite, the Mandarin caste, now taking the guise of the Chinese Communist Party. And it's always had the problem of satisfying the requirements of a very large population. So the risk of the Communist Party is that you have an American-style accumulation of wealth with a very small number of tech billionaires in a way that leaves a great many people out. What's interesting is to look at the stocks which are doing well today. All the Chinese semiconductor fabrication stocks are up. The stocks that did the worst on the mainland are in fact luxury stocks. All of the distillers and brewers got crushed, down by 6 to 10%. So this is an expression of anti-luxury, let's say, anti-populism, with a promise to the Chinese people that there's going to be a level playing field in terms of university education. Add to this the birth rate problem. That's a biggie for China. They're talking about very little else these days. There's a perverse incentive in all of Asia where the winner-take-all system incentivizes families to place all their resources into a single princeling, tutor him or her as much as you can and get him into a top university. That's one of the reasons you have very low birth rates all throughout Asia, not just China, but Taiwan, South Korea, and Japan. So there are a number of measures they're looking at, including on the housing side, to try to alleviate that.
David, that's a really good final point. We've got to leave it there, sir. Thank you for giving us some of your time late into the evening. David Goldman there, Asia Times business editor. Just a headline coming from Reuters I wanted to bring to you all. According to an official, the US will not lift travel restrictions, citing the Delta variant. That coming from Reuters this morning. Tom, the president, a couple of weeks ago now, in fact 2 weeks ago, said that in several days we'd have some information about the travel ban, and we haven't had that information as of yet. This is a report coming from Reuters. According to an official, the US will not lift travel restrictions, citing the Delta variant.
And some of this, John, is Canada. I mean, there's different borders, there's different arguments, but Canada's there, and there's like a 20-day differential there.
The bigger issue seems to be with Europe. That seems to be the bigger issue right now. And if this is about the Delta variant, and it's already so prevalent here in the United States, the dominant strain now, Tom, then what good is the travel ban? And if the United States citizens can still travel freely into Europe and back again, what does that achieve either? They're the kind of debates that are still taking place.
They are taking place, and my eyes glaze over on it. I really can't keep track of it.
I can't keep track either, Tom. Coming up on the
country
program.
to country, I just can't keep track.
Paul Romer will be joining us, NYU professor, Nobel laureate and former World Bank chief economist, on an important moment again for the global economy. Yields are lower by a couple of basis points to 125.29 on 10s. Your equity market down 6 on the S&P 500, negative 0.14%. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Heard on radio, seen on TV. This is Bloomberg. Four-day winning streak coming into Monday on the S&P 500 from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. 60 minutes away from the opening bell this Monday. Here's the state of play on the equity market. We're down 7, negative a little more than 1/10%, down by 0.15%. Yields come in a couple of basis points, down 2 to 125.29. Euro slightly stronger against the US dollar, 117.88. That currency pair positive 0.14%. And Tom, crude unchanged, back with the 72 handle, $72 and about 5 cents on WTI.
It's a terminal screen looking for market news, and maybe we'll get some of that news in the economic data and then to the Fed meeting on Wednesday. We start strong in this week of technology earnings. You do that with a laureate from New York University, Berkeley, Stanford, Rochester, and I think from Chicago as well. Paul Romer joins us now. We are thrilled to have him with us today on technology and what it has done to us. Professor, I want to go back to 1989 when you stopped the economics profession with human capital and growth, and then you went on to the technology inside our system, the endogenous technological change. How do you look at these 4, 5, 6 ginormous companies and what they have endogenously done to us?
Yeah. It's a very interesting story. The technological progress has been enormous. Better chips, better software, better devices. The effect on society has been ambiguous. We've had many good things, but also some bad things. I think that the bad things all trace back to this pivotal decision by Google, followed by Facebook, to switch to the advertising model, the targeted advertising model. This has had all kinds of repercussions that we're now living with, like another wave of the pandemic driven by vaccine hesitation that's been fostered via social media. So we've combined enormous technological progress with a really bad business model, and we're paying the price.
Should we break up these companies and to be narrow about it? If you can take Amazon with cardboard boxes, the cloud, and a burgeoning advertising business, as you mentioned, is it Standard Oil of New Jersey?
Well, I think first, I worked on the government side of the Microsoft case. I actually helped, design the proposed apps-ops breakup of Microsoft, which the judiciary just rejected at the appeals court level. I think it's extremely unlikely that a judiciary that's even more conservative now is going to approve a breakup of any of these firms. I think we just have to be realistic about that. So what I think we need to do, instead of focusing just on breakups, or at least government-forced breakups, is to change the incentives to get them to shift away from this targeted advertising, surveillance, spying kind of model, and to go back to the old-fashioned model where people pay to get things. So we could use things like the tax code, as I've suggested, to create incentives for firms to stop relying so much on advertising and to rely much more heavily on subscriptions, the way Netflix does.
Paul, is this tech dominance related to the stickiness of the high unemployment rate, of the stickiness of the low participation rate that we're currently seeing in the U.S. labor market?
Yeah, I don't think so. Reasonable people can differ, but I don't think this is the problem. I think fundamentally, we've been for 20 years now in a mode where the Congress wasn't able to do anything. So all of the work on recovery fell to the Fed. We used very low interest rates as a way to try and recover. but that meant that we ended up not recovering fast enough and far enough so that we've steadily ratcheted down the key metric I think we should be watching, which is the employment rate for 25 to 54-year-olds. So what we need to do now, and what we seem to be headed towards now, is something more like what we saw under Reagan, which is very aggressive, loose fiscal policy, stimulative fiscal policy, and as needed, tight monetary policy to keep inflation in check. So I think that we just have to recognize that it takes a long time. It's a slow process to get people back into jobs. We've just got to keep pushing on this recovery long enough to get back to where we should be, which is with a lot more people who are employed.
Paul, I want to stay on this point for a minute because there's been a lot of question around how much the enhanced unemployment rates, enhanced unemployment benefits, I should say, actually contributed to the stickiness of the participation rate remaining so low. There have been a number of studies that have challenged that. Other people saying that, look, the economy has not gotten back on. You still have people, childcare is still an issue. So what is the main why behind the stickiness right now at this point in the pandemic?
Yeah, I mean, if you look back at, the recovery from the recession in the early 2000s, getting people back into jobs is a slow process. It's very easy to kick people out of jobs. That happens very fast. And then remaking these matches between employers and employees just takes time. And so we have to be realistic in our expectations about how long that takes and maintain the conditions to keep getting people back into those jobs for as long as it will take. And it will take, I think many months to recover to the level we need to be at. We just have to be sure we don't give up too soon.
Paul, there's just all sorts of ways to go here. In the limited time we have left, I want you to talk about what everybody in this pandemic's gone through. And Greg Gilman at Yale University talks about it, the interiority of technology, how we're all sitting in our bedrooms or hunched over our computer doing computer stuff and not being social. Is that the ultimate risk to the United States? Are we going to be as lonely as Tom Keene, John Ferro, and Lisa Abramowicz?
Yeah. Well, somebody told me that the new acronym is FOGO. Instead of FOMO, fear of missing out, now it's fear of going out. So I think we're all suffering a little bit from this experience. But I think there's a kind of a realization which is coming, which is that these tech companies have benefited enormously from our greater reliance on them. And these tech companies are causing the problems we're seeing with vaccine hesitancy. So I think there's a backlash brewing against these firms. I don't think it's going to show up through a breakup via antitrust. I do think we're going to see legislation that reins them in.
I think, folks, again, this is the book, The End of the Myth by Greg Grandin, which is just a fabulous effort. Can't say enough about the history of this. Professor Romer, is where we are right now, like maybe we were with the railroads in 1930. I'll let you choose a technology. But this bouncing off of technology that we're all doing on a week of technology earnings, is that where we are right now as we've been before?
Yeah, I'm not sure that there is a good historical analog for what we're dealing with right now.
Yeah.
There's a very good story out in the New York Times this morning about disinformation for hire. These platforms have created weaponry, which is now available for purchase for anybody who wants to go out and create disinformation. There are some echoes of the period of yellow journalism here, but the scale of this and the speed with which these new platforms of propaganda and disinformation can operate is something we've just never encountered before, and I think it's very frightening.
Paul, just to wrap this all together, I'm curious about whether we could see some sort of China-like moves in the United States when it comes to regulatory crackdowns on big tech, on control of data. And this is actually something that surprised markets with respect to how ferocious some of these moves and dramatic these moves have been over in China. Is that a purely idiosyncratic move, or does this set the stage for the U.S. to take similar, albeit perhaps less dramatic moves?
Yeah, no, I think there's a very close parallel. Everybody thinks about how different we are from China, but in many ways our circumstances are very similar. We're on the verge of having platforms and companies that are so powerful and so influential in the political process that they're ungovernable, that they're beyond the rule of law, that the state can't actually get them to comply with the law. China has realized that this poses an existential threat to governance and law, and they've decided they have to stop it. We haven't gotten there yet in the United States, and I hope we get there soon, because the more influential these platforms of propaganda become, the harder it will be for us to reach a political consensus that we have to do something.
Professor, fantastic to get your views on this program. Paul Romer there of NYU, the Nobel laureate and former World Bank chief economist. Some of the longer-term issues we've got to grapple with. Let's deal with some of the nearer-term ones. This Wednesday, a Federal Reserve decision and news conference with Chairman Powell. This from Deutsche Bank. The incoming data will dictate the exact sequencing for the Federal Reserve. The risk relative to this expectation is that the June CPI inflation surge motivates the committee to accelerate taper talks, Deutsche Bank goes on to say, and send a clearer signal that tapering could be as early, Tom,
as September. Are they going to do that with a pandemic news flow, John?
I think that's the big question, Tom. I think that's the big question. How do they grapple with the incoming information? Does the data make them accelerate the timeline? Or, Tom, dare I say, is it the outlook? Is it the outlook that's going to change things for this Federal Reserve?
And it's going to be made up here Monday, Tuesday, and into Wednesday as well. Matt Lozzetti over at Deutsche Bank, John, as well, you know, on this goofiness and this parlor game of where growth is. He's got a more optimistic view than Goldman Sachs out to 2022, even into 2023. But again, he goes below potential way out in 2024.
I'll speak to a big bull in just a moment. In about 20 minutes' time, I'll catch up with Michael Purvis of Tallback and Capital Advisors.
He'll push
founder
against it.
And CEO. Michael Purvis, Lisa, upgraded his target when you were away to 4,800 on the S&P.
Coincidence?
Because you were away?
Yeah, because you know.
Is it a coincidence that we have record low real yields on a 10-year this morning with you back?
I don't know.
Welcome back. It's good to have you back, Lisa.
It's good to be
I hope
here.
you're nice and rested, because this week is a busy one.
It is.
With Lisa Abramowicz, Tom Keene, Jonathan Ferro, for our audience worldwide. Heard on radio, seen on TV, with your equity market just a little bit lower. This is Bloomberg Surveillance.
With the First Word News, I'm Laura Wright. Well, Jeff Bezos has followed up his trip into space with an offer to NASA. The world's richest person wrote to the space agency and said that it must quickly return to the moon. And he said he would waive up to $2 billion in fees as it competes with SpaceX for NASA's Human Landing System program. The White House is shifting the way it talks about inflation. Polls show there's increasing voter concern about rising prices, and Republicans are trying to use the issue to kill President Biden's plans to spend trillions on social programs amid infrastructure projects. Democrats plan to have the president use plain language explanations and assure people the price hikes will fade in time. China has announced a broad set of reforms for private education companies. It wants to decrease workloads for students and overhaul a sector it says has been hijacked by capital. Education companies will be banned from making profits, raising capital, or going public. That sent shares of education tech companies plummeting. The world's largest maker of semiconductors is considering whether to expand. Taiwan Semiconductor chairman Mark Liu told shareholders the company may build a chip-making plant in Germany. That's in addition to the one TSMC may build in Japan. Chip makers have been cranking up production to deal with shortages that have hammered automakers and other customers. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Laura Wright. This is Bloomberg.
we don't find any kind of rejection from our population regarding vaccines. This week we reach 52% of our total population with that is fully vaccinated. We expect to before the end of the summer to have 70% of our population fully vaccinated.
The Prime Minister of Spain, Mr. Sanchez, there with an update on what Spain is doing. They have had huge challenges, I know, in Barcelona, among others, and that speaks to the regionalization of what we see in this pandemic. On that moment, for the United States, Lloyd Minor joins us now to say he's with Stanford University and their School of Medicine dean. Barely describes his original research in medicine and also his academics. We're thrilled that Dr. Minor could join us today. Dr. Minor, a federal judge stood up last week and said Indiana University can force people in some way to get vaccinated. I know at Stanford you have a sterling record. I believe it's 257 illnesses, which is remarkable given the size of Palo Alto. But what is your policy? Are you heading towards where Indiana is?
Well, good morning, Tom. It's good to be with you. We do have a policy requiring vaccination for all healthcare workers and also for students at Stanford. There are provisions for people to apply for exemptions based upon medical or religious reasons. But we strongly encourage people to be vaccinated, and we're seeing a very high number of people in our system who are vaccinated.
That's right where I wanted to go. If you have that policy from someone of your repute, or frankly, Indiana University as well, do you see action on the part of the unvaccinated?
Yes, we do. Roughly 85% of people in our healthcare delivery system today are vaccinated. That number may be larger. We're still collecting the data. And that it continues to increase every day. I think vaccine hesitancy is coming down. We're seeing just how effective these vaccines are. And of course, with the emergence of the Delta variant, vaccination is even more important.
Dr. Minor, our colleague John Ferro pointed to a headline this morning out of Reuters, an exclusive report by them saying that the U.S. will not lift travel restrictions, citing this Delta variant, saying it is too early. Does this make sense from your perspective based on the science?
It's always hard to know when to impose restrictions on the mobility of people or the activities of people. Certainly the Delta variant is more transmissible, but we do know that the vaccines are highly effective at preventing severe disease from the Delta variant. You know, over the past several weeks, over 99% of the deaths in the United States from COVID-19 have been in unvaccinated people. So while there is still a risk of infection in people who are vaccinated, the disease is typically much less. Now, also, we know that masking and observing social distancing are effective measures as well. I think the decision on when to impose a travel restriction is one of the most difficult decisions our government leaders can make. I think the more we can do to keep track of the pandemic, where it's spreading, where it's receding, will help to inform those decisions.
A very diplomatic answer, Dr. Minor. There is a question also going forward of what we ought to be tracking in order to understand that we can open up our borders, we can open up some of these restrictions in full in a comprehensive and, frankly, united way. Is it fair? Is there a threshold of hospitalizations or death rates that we can look to signal that perhaps we have the all clear and can go back to life as normal?
I think you pointed out the critical point to monitor, and that is hospitalizations. We know that what happened early in the pandemic, the tragedy in New York in April and May of last year, that was related to the healthcare delivery systems becoming overwhelmed, not enough hospital beds, not enough ventilators, in some cases, not enough oxygen. We can't allow that to happen again. We're going to continue to see mild to moderate illness for weeks, months ahead, because this pandemic, the virus continues to mutate. There are more transmissible forms that emerge. So it's going to be we're going to be living with COVID for a long time, but we have to make sure that we don't overwhelm healthcare delivery systems.
When I look at this, I look, Dr. Minor, at a nation, as Tocqueville talked about, which is anti-intellectual, anti-science. And I know every other nation has the same challenges as well. Stanford is one of our resources of science, and I mean that in a philosophy sense. How do we shift this philosophy in America?
Well, I think there's a big responsibility for those of us who are in science and medicine to be better communicators than we have been in the past. When we don't know something, we need to say that we don't know it. We also need to help people understand what the process of gaining evidence is. You know, no one, I think, very few people 2 years ago would have predicted that something like COVID-19 would happen in our time, and it did. And we're still learning about rates of transmission, how the virus changes over time, and what can be done to prevent its spread. We do know, however, that the vaccines that have been developed and given FDA emergency use authorization in the United States are among the most safe and effective vaccines ever to be deployed.
We have to leave it there. Dr. Miner, thank you so much. Lloyd Miner with an update, an important update from Stanford University as well. Lisa, I want to go back, I think it was 2 hours, to your comments on school. All of a sudden, on a Monday morning, I'm seeing in the zeitgeist a little bit of study of where are we in 14 days.
Honestly, to me, this is one of the biggest unknowns out there. If we can't get kids back in school in person and we can't get healthcare and childcare back to where it was before, how can people go back to the office?
What do you do with kindergarten?
Well, I think that increasingly, especially the younger children, look, just from my background and my family, frankly, as early childhood educators with a number of them, it's incredibly important for it to be an experientially driven, really in-person moment for especially the younger
like
generations.
Surveillance every day.
Exactly. I want to just bring up something else because I'm shocked that you have not brought it up earlier.
Right.
Bitcoin rallying. Surging past 40,000.
We've touched it, and I mean, it's out there. Joe Weisenthal's doing up a storm on Twitter about it. I don't know. I can't understand his tweets. I don't know what
I think it's fascinating.
I have no idea what he's doing.
Here, you've got, first of all, the negative real yields, and when they go more negative, people tend to go into Bitcoin, so that's one aspect of it. But the other one is that Amazon.com posted a job listing for a digital currency and blockchain strategy head. And so people are speculating that they could get into this, and that's enough to prop up the price. And then other people are saying short covering. I think it's interesting, the idea of the adoption. I mean, Venmo increasingly even having a digital currency checkbox.
38,000, pushing 39,000 on BitDog. Maybe we'll get to 40,000 all clear. Up will go, moonshot to 60,000.
You're not excited?
I'm not on board. Matt Miller's loaded up to his eyeballs on Bitcoin.
No, he gets very excited. I just thought you'd want to talk about BitDog.
No, it's there, and it was 29,000 when you were with the Loons and the Bears. Loons and the Bears demand a data check. Futures -11, Dow futures -102 off those record highs that we saw on Friday. The VIX 18.57 as well. Coming up on Bloomberg Radio and Bloomberg Television, good conversation, including with Ambassador Haas, 12 noon, with David Weston. Stay with us. This is Bloomberg. Good morning.